Welcome back. Tonight, we're pulling back a curtain that most people don't even know exists. We're talking about two names that appear everywhere yet remain invisible to the average person. Two financial entities that have woven themselves into the fabric of modern existence so completely that they've become part of the infrastructure itself. BlackRock and Vanguard. You've probably never thought about them. Most people haven't. But they've thought about you. To understand how BlackRock and Vanguard became the quiet overlords of global finance, we need to go back to their beginnings. These weren't companies born from inherited wealth or government favoritism. They emerged from the financial system itself, products of innovation, timing, and a few spectacular failures that taught their founders lessons the rest of Wall Street hadn't learned yet. BlackRock's story begins with a man named Larry Fink. Born in 1952 inches Los Angeles to a middle-class Jewish family, Fink wasn't destined for greatness by birth. His father owned a shoe store. His mother was an English professor. Nothing about his upbringing suggested he would one day control more wealth than most nations possess. But Fink had something that mattered more than connections or family money. He had an obsessive attention to detail and an ability to see patterns in numbers that others missed. After graduating from UCLA with a degree in political science and earning his MBA, Fink landed at First Boston Corporation in 1976. This was the era when Wall Street was inventing new ways to slice, package, and sell financial products. Fink found himself working in the bond trading department, specifically dealing with a relatively new innovation called mortgage-backed securities. The concept was simple but revolutionary. Take thousands of individual home mortgages, bundle them together, and sell pieces of that bundle to investors. Instead of a bank holding onto a mortgage for 30 years, they could package it with others and sell it immediately, freeing up capital to make more loans. It was the kind of financial engineering that would later be blamed for nearly destroying the global economy, but in the late 1970s and early 80s, it seemed like genius. Fink was good at it. Very good. By 1978, just 2 years into his career, he was running First Boston's entire bond department. By his late 20s, he had become one of the youngest managing directors on Wall Street. The numbers flowing through his department were staggering. Some estimates suggest Fink personally added $1 billion to First Boston's bottom line during his tenure. He was a golden boy, the kind of rising star that Wall Street loves to celebrate. And then, in 1986, everything fell apart. Fink's team made a bet on interest rates. They were wrong. The miscalculation cost First Boston $100 million in a single quarter. To understand the magnitude of this loss, you have to remember that this was 1,986. $100 million was an astronomical sum, especially for a loss that came from what was supposed to be a safe, sophisticated trading operation. The loss didn't just hurt the company's balance sheet. It destroyed Fink's reputation. The Golden Boy had crashed and burned spectacularly. Within 2 years, Fink was out. As he later put it, he didn't have the option to stay. For most people, a failure like that would be career-ending. For Fink, it was transformative. The loss haunted him, but not in a way that made him risk-averse. Instead, it made him obsessive about one thing: risk management. He realized that the problem wasn't the complexity of the financial instruments they were trading. The problem was that nobody truly understood the risks embedded in those instruments. The whole system was built on assumptions and models that looked elegant on paper but crumbled when conditions changed. Fink became convinced that with the right technology, the right analytical tools, you could measure and manage risk in ways that Wall Street had never imagined. In 1988, Fink and 7 partners founded a new company. They called it BlackRock, a play on the black box of fixed-income analytics they were building. The company started as a subsidiary of the Blackstone Group, the investment firm founded by Peter Peterson and Stephen Schwarzman. The initial focus was narrow: manage risk for institutional clients investing in bonds. Fink's pitch was simple but powerful. We won't just invest your money. We'll understand the risks in ways that other firms can't, because we've built technology that can analyze every variable, every scenario, every potential outcome. We learned from the mistakes that destroyed careers at other firms. We won't make those mistakes again. The pitch didn't work at first. Fink and his team spent nearly a year being laughed out of meetings. They were too new, too small, too unproven. Why would major institutions trust a startup run by a guy who had just lost $100 million at his last job? The rejections piled up. The skepticism was everywhere. But Fink persisted, and eventually he got his breakthrough. General Electric, one of the largest corporations in America with one of the most valuable pension funds in existence, agreed to let BlackRock manage a portion of their money. Landing GE changed everything. It gave BlackRock credibility. If GE trusted them, other institutions would follow. And they did. Throughout the 1,990 seconds, BlackRock grew steadily, building out their technology platform and expanding beyond bonds into other asset classes. In 1994, BlackRock became independent from Blackstone. In 1999, they went public. By the end of that year, they were managing $165 billion in assets. It was an impressive number, but nothing compared to what was coming. The real transformation came in the 2000s, driven by two seismic events. The first was a strategic acquisition. In 2006, BlackRock purchased Merrill Lynch Investment Managers for nearly $10 billion. This wasn't just about getting bigger, it was about diversification. Merrill Lynch brought expertise in equities, mutual funds, and global markets. Overnight, BlackRock went from being a bond specialist to being a full-service asset manager. Their assets under management jumped from around $500 billion to over $1 trillion. They had entered the big leagues. But it was the second event, the 2008 financial crisis, that truly cemented BlackRock's position as something unprecedented in financial history. When the housing market collapsed and the global financial system teetered on the edge of complete meltdown, governments and central banks needed help. They needed someone who understood the toxic mortgage-backed securities that were poisoning bank balance sheets. They needed someone with the technology to analyze these incredibly complex instruments and figure out what they were actually worth. They needed someone they could trust, to be objective, to not have their own positions that would create conflicts of interest. They needed BlackRock. Larry Fink became the fixer. The United States Treasury called, the Federal Reserve called, foreign governments called. BlackRock was hired to help manage the bailouts, to analyze the distressed assets, to advise on which firms could be saved and which needed to fail. This wasn't just consulting work. This was influence at the highest levels of government during the worst financial crisis since the Great Depression. And BlackRock's technology, particularly their risk management platform called Aladdin, proved invaluable. While other firms were drowning in complexity, BlackRock had the tools to see through the chaos. The crisis also created opportunities. In 2009, BlackRock acquired Barclays Global Investors, including the iShares brand of exchange-traded funds. This was the acquisition that truly transformed the company. iShares was one of the largest ETF providers in the world, and ETFs were about to become the investment vehicle of choice for everyone from individual investors to massive institutions. BlackRock suddenly found itself at the center of a fundamental shift in how people invested. The price tag was $13.5 billion. The payoff was incalculable. By 2014, BlackRock was managing $4 trillion. By 2020, it was over $10 trillion. Today, it's over $11.5 trillion in assets under management. To put that in perspective, BlackRock manages assets worth roughly 40% of the entire United States gross domestic product. They manage more money than all the sovereign wealth funds in the world combined. They manage more than 3 times what the entire global hedge fund industry manages. And they did it by being the firm that understood risk better than anyone else, the firm that built the technology nobody else had, and the firm that was in the room when governments needed help during the worst crisis in generations. But BlackRock's rise, as remarkable as it is, represents only half of the story. Vanguard's journey is completely different, yet equally important to understanding how we arrived at this moment of concentrated financial power. Vanguard was founded in 1975 by a man named John Bogle. If Larry Fink's origin story is about learning from catastrophic loss, Bogle's story is about a revolutionary idea that the entire financial industry opposed. Bogle believed that most investment managers were charlatans, or at least irrelevant. He had looked at the data, and the numbers were damning. The vast majority of actively managed mutual funds failed to beat the market over the long term, yet these funds charged high fees for the privilege of underperforming. Bogle thought this was absurd. Why pay someone to pick stocks when they couldn't consistently pick better stocks than the market average? Why not just own the entire market? This idea, which seems obvious now, was heretical in 1975. The entire investment industry was built on the premise that smart people could beat the market, that expertise mattered, that paying for professional management was worth it. Bogle was saying they were all wrong. Or worse, that they were engaged in a sophisticated form of theft, charging fees for a service they couldn't actually provide. The response from the industry was predictable. They called him crazy. They said it would never work. They said investors wanted to beat the market, not settle for average returns. Bogle didn't care. In 1976, Vanguard launched the first index investment trust, the first index mutual fund available to individual investors. It tracked the S&P 500, meaning it simply owned all 500 stocks in the index in proportion to their market weights. No stock picking, no market timing, no genius fund manager making calls. Just own everything and charge minimal fees for the service of maintaining the portfolio. The industry called it Bogle's Folly. The initial fundraising was a disaster. They hoped to raise $150 million. They got $11 million. It seemed like the skeptics were right. Nobody wanted to invest in a fund that admitted it couldn't beat the market. But Bogle understood something that the rest of Wall Street didn't want to acknowledge. Over time, low fees compound into enormous savings. If an actively managed fund charges 1.5% annually and an index fund charges 0.05%, that 1.45% difference might not sound like much. But compound that over 30 years, and it's the difference between retiring comfortably and retiring wealthy. The math was undeniable, and slowly, investors started to figure it out. Vanguard's index funds began to grow, not quickly at first, but steadily, inexorably, like water eroding stone. The genius of Vanguard wasn't just the index fund concept, though. It was the ownership structure. Bogle set up Vanguard in a unique way. The company is owned by the funds, which are owned by the investors in those funds. In other words, if you invest in a Vanguard fund, you technically own a piece of Vanguard itself. This structure meant that Vanguard had no outside shareholders demanding profits. The company existed solely to serve the investors in its funds. This allowed Vanguard to keep fees low because they weren't trying to extract profits for external owners. Every dollar saved on expenses went back to the investors. This structure also makes Vanguard opaque in interesting ways. Who owns Vanguard? The investors do. But who are the investors? Millions of people. Who makes decisions at Vanguard? The board does, but they're elected by representatives of the funds, which represent the investors. It's a circular ownership structure that technically makes Vanguard accountable to everyone and no one simultaneously. This will become important later when we talk about the conspiracy theories, because pinpointing who actually controls Vanguard is genuinely difficult. For decades, Vanguard grew steadily but not spectacularly. The index fund revolution took time. But by the 1992nd and 2000s, the tide had turned. Study after study confirmed what Bogle had been saying all along. Most active managers couldn't beat the market after fees. The rise of academic finance, particularly the efficient market hypothesis, provided intellectual backing for index investing. And, as more investors piled into index funds, those funds grew larger, which allowed them to cut fees even further, which attracted more investors. It was a virtuous cycle that accelerated with every passing year. The 2008 financial crisis supercharged this trend. Investors watched actively managed funds blow up. They watched hedge funds fail spectacularly. They watched financial advisors prove they had no idea what was happening. In the aftermath, the flight to low-cost index funds became a stampede. Why pay 2% annually to a hedge fund that just lost half your money when you could pay next to nothing for an index fund that went down with the market but would recover with the market? Vanguard's assets exploded. By 2015, they had crossed $4 trillion under management. Today, they manage over $8 trillion. Together, BlackRock and Vanguard represent two different paths to the same destination. BlackRock built technology and expertise that made them indispensable during crises. Vanguard built a better mousetrap that eventually forced the entire industry to adapt or die. BlackRock grew through acquisitions and government relationships. Vanguard grew through relentless focus on low costs and index investing, but both ended up in the same place, managing trillions of dollars with ownership stakes in virtually every major corporation in the world. Their rise coincided with other massive shifts in the financial landscape. The growth of pension funds and retirement accounts meant that more and more money was being invested for the long term. The shift from defined benefit pensions to defined contribution plans, like 401(k), meant that individuals were suddenly responsible for investing their own retirement savings, and they needed simple, low-cost options. The explosion of ETFs created new vehicles for both institutional and retail investors. And the increasing complexity of global markets made risk management and diversification more important than ever. BlackRock and Vanguard didn't create these trends. They capitalized on them brilliantly. They were in the right place at the right time with the right products and the right structure, but their success has created something novel in economic history. Never before have two private entities held such significant ownership positions across so many competing companies in so many different industries. The scale is unprecedented. The implications are still being understood. The conspiracy theorists look at BlackRock and Vanguard and see puppet masters orchestrating global events. The financial industry looks at them and sees successful companies that innovated and executed well. The truth, as always, is more complicated. These companies grew powerful not through shadowy cabals, but through being useful. They solved real problems. They built better technology. They offered better products at lower prices. They became indispensable to a system that was evolving toward concentration, whether anyone planned it that way or not. But intention doesn't determine outcome, whether they meant to or not. BlackRock and Vanguard now occupy a position that would have been unimaginable when Larry Fink walked out of First Boston with a destroyed reputation, or when John Bogle launched his ridiculous index fund that nobody wanted. They've become infrastructure. Essential, embedded, too big, too interconnected, too important to fail or even to regulate. Without risking the entire system, they've become part of. And that's just the origin story. That's just how they got here. What they do with all that power, how the system actually works, how deeply they're embedded in every aspect of modern life, that's where things get really interesting. Because understanding how BlackRock and Vanguard came to be is one thing. Understanding what they've become is something else entirely. If you want to understand how two companies can appear to own everything without technically owning anything, you need to understand how modern institutional ownership actually works. This isn't a simple story. The complexity is part of what makes it so effective. The system operates in plain sight, documented in public filings that anyone can read, yet remains invisible to most people because it's wrapped in layers of financial terminology that make eyes glaze over. But strip away the jargon, and what you're left with is a mechanism for concentrating influence that's more elegant and more powerful than anything a conspiracy could design. Let's start with the basics. When you hear that BlackRock or Vanguard owns a company, what does that actually mean? They don't own it the way you might own a car or a house. They're not the sole proprietors making every decision. They hold shares in that company, and those shares represent fractional ownership. If a company has 1 billion shares, outstanding, and BlackRock holds 70 million of them, then BlackRock owns 7% of that company. Simple enough. But here's where it gets interesting. BlackRock isn't holding those shares for itself. It's holding them on behalf of its clients. This is the foundation of institutional investing. When you put money into a BlackRock fund, that money gets invested according to the fund's strategy. If it's an S&P 500 index fund, your money gets spread across all 500 companies in that index in proportion to their market capitalization. BlackRock is the legal owner of the shares, but you're the beneficial owner. You're the one who profits if the value goes up. You're the one who loses if it goes down. BlackRock is just the custodian, the intermediary, the manager. In theory, they're working for you. Now, multiply this across millions of investors putting trillions of dollars into thousands of different funds. BlackRock manages over $11 trillion, but that's not BlackRock's money. It belongs to pension funds, sovereign wealth funds, endowments, foundations, insurance companies, and millions of individual investors with retirement accounts. The same is true for Vanguard's $8 trillion, for State Street's $4 trillion, for every major asset manager. They're managing other people's money. This is crucial to understanding why they appear everywhere without technically controlling everything. But here's the thing that critics focus on, and it's a legitimate point. Even though BlackRock and Vanguard are managing other people's money, they're the ones who vote the shares. This is called proxy voting, and it's where the real power lies. When you own stock in a company, you get to vote on important matters. Who sits on the board of directors? Whether to approve a merger? How much to pay executives? Whether to adopt certain environmental policies. These votes shape corporate strategy and governance. And when you have tens of millions of shares, your vote matters a lot. Most individual investors never exercise their voting rights. They don't have time, don't have expertise, and frankly don't care enough to vote on every shareholder proposal for every company they own through their index funds. So the asset managers vote for them. BlackRock has an entire division called BlackRock Investment Stewardship that handles voting for all the shares in BlackRock funds. Vanguard has a similar structure. They employ teams of analysts who study governance issues, meet with corporate executives, and cast votes on behalf of the millions of investors whose money they manage. In recent years, there's been some movement toward giving investors more say in how their shares are voted. BlackRock launched something called the Voting Choice Program in 2021, which allows certain institutional clients to direct how their votes should be cast. In 2023, they extended a version of this to retail investors in their largest ETF, but these programs are limited in scope and uptake. The vast majority of voting is still done by the asset managers themselves, which means that when BlackRock is the largest shareholder in a company, the people running BlackRock Investment Stewardship have enormous influence over that company's decisions. Now, let's scale this up. BlackRock and Vanguard together are among the top 3 institutional investors in 100% of S&P 500 companies. Every single one. They're the single largest institutional investor in 84% of those companies. This means they're voting massive blocks of shares in virtually every major corporation in America. They're in the boardrooms, not physically, but through the weight of their shareholdings. When management proposes something, they have to consider how BlackRock and Vanguard will vote. When activists push for changes, they need BlackRock and Vanguard on their side. When boards make decisions, they're acutely aware of what the largest shareholders want. This is passive investing's paradox. The funds themselves are passive. They just track indexes. They don't actively pick stocks. But the voting power is anything but passive. You can't own 7 or 8 or 9% of a company and be passive. That's active influence whether you intend it or not. The sheer size of the position creates gravitational pull. Companies pay attention to their largest shareholders, even when those shareholders claim to be hands-off. And here's where the conspiracy theories gain traction. BlackRock and Vanguard aren't just major shareholders in one company per industry. They're major shareholders in competing companies within the same industry. Look at airlines. Vanguard is the largest institutional shareholder in Delta, American, and United. BlackRock is the second largest in all three. Same pattern in banking. Vanguard and BlackRock are top shareholders in JP Morgan Chase, Bank of America, Wells Fargo, and Citigroup. In pharmaceuticals, they're major. Investors in Pfizer, Merck, Johnson & Johnson, and AbbVie. In technology, they're substantial shareholders in Apple, Microsoft, Google, Amazon, and Meta. In media, they own significant stakes in Disney, Comcast, Fox, and Warner Bros. Discovery. This is called common ownership, and it's pervasive. When the same shareholders own stakes in companies that compete with each other, it creates complex incentives. From a traditional economic perspective, competition is good because it drives companies to innovate, cut costs, and serve customers better. But if you're a shareholder in all the competing companies, do you really want them competing too aggressively? If a price war breaks out between Delta and United, and you own shares in both, you don't win. You just watch two of your investments destroy value to take market share from each other. From a diversified shareholder's perspective, the ideal scenario might be for companies to compete just enough to avoid regulatory scrutiny, but not so much that they erode profitability across the industry. There's academic research suggesting that common ownership might contribute to decreased competition in certain industries. A 2015 study found that airline ticket prices were about 3 to 5% higher on routes where common ownership among airlines was more concentrated. Other research has examined banking, pharmaceuticals, and other sectors with similar findings. The theory is that when shareholders own stakes in all competitors, they pressure management to focus on industry profitability rather than market share, which effectively reduces competitive intensity. The companies aren't colluding directly. That would be illegal. But the ownership structure creates aligned incentives that lead to similar outcomes. The defenders of this system argue that correlation isn't causation. Prices might be higher for lots of reasons unrelated to ownership structure. They point out that BlackRock and Vanguard invest in index funds that track the entire market. So of course they own competing companies. They own everything. They note that these firms have explicitly stated they support competition and don't coordinate across their portfolio companies. They emphasize that BlackRock and Vanguard have different clients with different interests, so there's no single unified agenda being pushed. And they argue that the benefits of index investing, lower costs, broader diversification, easier access to markets outweigh any theoretical concerns about common ownership reducing competition. Both sides have valid points, but here's what's undeniable. The concentration of ownership has increased dramatically over the past 2 decades. In 2008, the Big Three, BlackRock, Vanguard, and State Street, collectively managed about 13.5% of S&P 500 equity. By 2017, that had grown to over 20%. Research from Harvard suggests that if trends continue, these three firms could collectively cast as much as 40% of votes in S&P 500 companies within the next decade or two. We're watching, in real time, a concentration of voting power that has no historical precedent. And it's not just in the United States. BlackRock and Vanguard have expanded globally. They're major shareholders in European companies, Asian corporations, Latin American firms. The same pattern repeats everywhere. Look at the largest companies in any developed market, and you'll find BlackRock and Vanguard near the top of the shareholder list. They've become a feature of global capitalism itself, embedded in the ownership structure of the modern economy. The growth of passive investing has accelerated this concentration. In 2008, passive funds, primarily index funds and ETFs, owned about 7% of the S&P 500. Today, that number is around 24% and climbing. As more investors shift from active management to passive index funds, more assets flow to the firms that dominate passive investing. BlackRock, Vanguard, and State Street control about 74% of the entire equity ETF market. They've created something close to a natural monopoly in passive investing. Not through anti-competitive practices, but through scale, first-mover advantages, and a virtuous cycle where size begets lower costs, which beget more inflows, which beget more size. This creates network effects. If you're a company and you want to launch a new index fund or ETF, you're competing against the big three's scale, their technology, their brand recognition, and their ability to offer rock-bottom fees that smaller players can't match. It's not impossible to compete, but it's extremely difficult. The result is that the passive investing industry, despite having low barriers to entry in theory, has become highly concentrated in practice. Now, let's talk about what this means in practical terms. When BlackRock or Vanguard shows up as a major shareholder, what actually happens? Companies pay attention. The big three don't usually make public demands or wage proxy fights. That's not their style. Instead, they engage in private dialogue with management and boards. They express preferences, they ask questions, they share perspectives on governance, strategy, and risk. Because they're long-term holders who can't easily sell their positions without moving markets, they have incentive to push for changes from within rather than from outside. In recent years, this engagement has focused heavily on environmental, social, and governance issues, commonly known as ESG. BlackRock's Larry Fink has become famous for his annual letters to CEOs, where he's pushed companies to address climate change, improve board diversity, and think about stakeholder capitalism. This has made BlackRock a target from both the left, who say they don't go far enough, and the right, who accuse them of pushing a political agenda. In 2023, multiple Republican-led states pulled investments from BlackRock, claiming the firm was boycotting fossil fuels and prioritizing woke politics over returns. Meanwhile, environmental groups criticized BlackRock for continuing to invest heavily in oil and gas companies. The truth is probably more mundane than either side wants to admit. BlackRock and Vanguard are fiduciaries. They're legally obligated to act in the financial interests of their clients. If they believe climate risk is a financial risk, which increasingly they do, then pushing companies to address climate change isn't political activism, it's risk management. Similarly, pushing for board diversity might be about better governance and decision-making rather than social justice. But the scale of their influence means that even business-focused decisions get interpreted through political lenses. When the largest shareholder in most major corporations starts pushing in a certain direction, that's power, whatever you call it. There's also the question of coordination. BlackRock and Vanguard often vote the same way on shareholder proposals. Is that because they're coordinating? Probably not directly. They're both large institutional investors with similar time horizons and similar views on governance best practices. They're reading the same research, talking to the same companies, and reaching similar conclusions, but the effect is the same as if they were coordinating. When both firms support or oppose something, that's a combined voting bloc large enough to determine outcomes at many companies. They don't need to coordinate explicitly. The structural similarity of their positions creates de facto coordination. This brings us to the heart of why this system generates conspiracy theories. It looks like control. It walks like control. It quacks like control. But everyone involved insists it's not control because the asset managers are acting on behalf of millions of clients who are the beneficial owners. It's ownership without ownership. Influence without control. Power. That's simultaneously real and ephemeral. You can see it in the numbers, in the shareholder lists, in the voting records, but when you try to point to who's actually wielding that power, it disperses into millions of retirement accounts and institutional mandates. The legal structure provides cover. BlackRock doesn't own those shares, it manages them. Vanguard doesn't control those companies. It votes as a fiduciary. Both statements are technically true. But when you manage enough shares and vote enough proxies, the distinction between management and ownership becomes academic. You have influence. You have access. You have the ability to shape decisions. Whether you legally control, something becomes less important than what you can practically accomplish. And here's the truly brilliant part. Because this influence comes from managing other people's money, it's largely insulated from the kind of scrutiny and regulation that would apply if BlackRock and Vanguard were using their own. Capital. They're not monopolists in the traditional sense. They're not acquiring competitors or fixing prices or abusing market power. They're just offering investment products that people want to buy. The fact that offering these products has made them the largest shareholders in nearly every major company is an emergent property of the system, not a deliberate strategy to accumulate control. This is why regulation has been so difficult. What law are they breaking? They're not colluding. They're not manipulating markets. They're just large. Being big isn't illegal. Having significant shareholdings in multiple companies isn't illegal. Voting those shares according to your view of what's in the financial interests of your clients isn't illegal. Everything they do operates within the existing regulatory framework. The problem, if there is one, isn't that they're breaking rules. It's that the rules were written for a different era, when ownership was more direct and concentrated power, was easier to identify and regulate. The 20th century antitrust framework focused on horizontal integration, companies in the same industry merging, and vertical integration, companies at different points in the supply chain combining. The concern was always about direct control and market power within a specific industry, but BlackRock and Vanguard don't fit that model. They're not in any particular industry. They're in all industries simultaneously, but only as minority shareholders. They don't have direct control over any single company, but they have influence over nearly all companies. It's a new form of economic power that existing laws weren't designed to address. Some economists and legal scholars have proposed new regulations. Ideas include limiting the percentage of an industry that any single fund family can own, requiring greater transparency in voting decisions, mandating that asset managers offer clients more control over proxy voting, or even restricting common ownership of direct competitors. But each of these proposals faces significant obstacles. The index fund industry would argue that such regulations would harm investors by increasing costs and reducing returns. The asset managers would say they're already acting as fiduciaries and don't need additional oversight. And politically, it's hard to build consensus for regulating an industry that most people don't understand and that appears to be working well for many investors. So the system continues. More money flows into passive funds. BlackRock and Vanguard grow larger. Their ownership percentages in companies increase. Their voting power expands. The concentration accelerates. And we're left with a situation where two private companies, accountable primarily to their clients and shareholders rather than to any democratic process, wield economic influence that rivals many governments, all while operating within the letter of the law and claiming to be passive participants in the market. This is how ownership works in the 21st century. It's not the robber barons of the Gilded Age, individuals or families controlling industries through direct ownership. It's not the conglomerates of the mid-20th century, sprawling corporations owning subsidiaries across multiple sectors. It's something newer and stranger, firms that own pieces of everything through index funds that track the entire market, creating a web of interconnected ownership so complex that locating actual control becomes nearly impossible, even as the influence remains undeniable. The conspiracy theories write themselves, because the reality is almost too bizarre to believe. Two companies show up on the shareholder list of practically every major corporation. They vote on boards and policies across every industry. They have relationships with governments and central banks. They manage assets worth more than most national economies. And yet they insist they're just neutral intermediaries, passive investors, faithful stewards of other people's money. Both things are true simultaneously. They are passive, they are powerful, they don't control anything, they influence everything. Welcome to modern finance, where the truth sounds like fiction, and the fiction sounds like Tuesday. If you want to understand why people talk about BlackRock and Vanguard as shadow puppeteers, you need to look at media ownership. Because when the same two companies show up as major shareholders in Fox News and CNN, in Disney and Comcast, in every major newspaper chain and local television conglomerate, it raises questions that can't be dismissed as conspiracy theory. These are documented facts, publicly available in SEC filings, and they paint a picture of concentrated influence over information flow that should make anyone uncomfortable. Let's start with the numbers. Together, BlackRock and Vanguard own 18% of Fox Corporation, 16% of CBS, 13% of Comcast, which owns NBC, MSNBC, CNBC, and the Sky Media Group, 12% of CNN through its various corporate structures, 12% of Disney, which owns ABC, ESPN, and a sprawling empire of entertainment properties. They're major shareholders in Sinclair Broadcast Group, which owns 223 television stations across the United States, reaching 72% of American households. They own significant stakes in Gannett, which publishes more than 250 daily newspapers, including USA Today. They're invested in every major media company that shapes what Americans see, hear, and think about the world. This isn't hidden information. It's right there in shareholder disclosures. Harvard researchers compiling data on media ownership found BlackRock and Vanguard appearing again and again as top institutional investors. These two firms are among the largest shareholders in the 6 media conglomerates that control over 90% of what Americans watch on television and read in newspapers. They don't own controlling stakes, they're not the majority shareholders in any of these companies, but they own enough to matter, to have influence, to be insiders under securities law. Think about what this means practically. When BlackRock and Vanguard own substantial stakes in competing news networks, they're in a position to benefit from the entire media ecosystem, regardless of which network wins the ratings war on any given night. If Fox's viewership goes up, BlackRock and Vanguard profit. If CNN's ratings surge, BlackRock and Vanguard profit. If people switch from cable news to streaming Disney Plus, BlackRock and Vanguard profit because they own Disney too. They're not rooting for any particular outlet. They're rooting for the system itself, for media consumption in general, regardless of the content or the political slant. This creates perverse incentives. If you own both sides of every debate, do you really want those debates to be resolved? Or do you want them to continue indefinitely, keeping audiences engaged, keeping them watching, keeping them clicking? Because engagement drives advertising revenue, which drives stock prices, which drives returns for your funds. If you're a major shareholder in Fox News and CNN, simultaneously, the ideal scenario isn't for one to crush the other. It's for both to thrive by maintaining the impression of fierce competition while neither actually threatens the other's existence or business model. The conspiracy narrative practically writes itself. Two corporations own stakes in all the major news outlets. These outlets present themselves as rivals, as representing different perspectives, as holding each other accountable. But behind the scenes, they share common owners who benefit from the conflict itself rather than from any particular side winning. It's professional wrestling applied to news media. The rivalries are real in the sense that the people involved genuinely disagree and compete, but the business interests behind those rivalries are aligned in ways the audience doesn't see. Now, defenders of this system will correctly point out that BlackRock and Vanguard don't make editorial decisions. They're not telling journalists what stories to cover or which opinions to express. They're not Fox executives or CNN producers. They're just investors who own shares. And that's technically true. But influence doesn't require direct control. It works through more subtle mechanisms. Through board relationships, through strategic priorities set at the corporate level. Through the overall business environment that determines what kinds of journalism get funded and what kinds get cut. When the same institutional investors own all the major media companies, they have an interest in the media industry remaining profitable and stable. They don't want disruption. They don't want major regulatory changes that might hurt the business model. They don't want investigative journalism that might expose problems with other companies in their portfolio. They want content that attracts audiences and advertisers while minimizing legal risks and controversy that could threaten share prices. This creates a gravitational pull towards safe, predictable, profitable content rather than challenging, risky, investigative work. Consider the relationship between media companies and pharmaceutical companies. BlackRock and Vanguard are also major shareholders in Pfizer, Johnson & Johnson, Merck, and every other pharmaceutical giant. During the COVID pandemic, pharmaceutical advertising made up a huge portion of news network revenue. Networks relied on pharma ads to stay profitable. Now imagine you're a producer considering a critical investigation into pharmaceutical pricing or vaccine side effects. You know your network depends on pharma advertising. You know your network's largest shareholders also own massive stakes in the pharmaceutical companies. You know that alienating either the advertisers or the shareholders could threaten your career. How hard do you push that investigation? This isn't a hypothetical. Media critics have pointed out for years that coverage of pharmaceutical issues tends to be softer, less critical, more deferential than coverage of other industries. The standard explanation is that networks don't want to lose advertising revenue. But the ownership overlap adds another layer. When your shareholders are the same as your advertisers' shareholders, when the same institutional investors own both the media companies and the companies being covered, the incentives all point in one direction. Don't rock the boat. The same pattern repeats across industries. BlackRock and Vanguard own media companies and oil companies, media companies and defense contractors, media companies and big banks, media companies and tech platforms. Pick any controversial industry, any sector facing criticism or calls for regulation, and you'll find BlackRock and Vanguard owning stakes in both the companies doing potentially problematic things and the media companies theoretically supposed to hold them accountable. The watchdogs and the watched are owned by the same entities. This gets even more troubling when you look at the political dimension. BlackRock and Vanguard don't just influence what you watch. They have direct relationships with political power that most people don't understand. When the 2008 financial crisis hit, BlackRock became the go-to advisor for the U.S. Treasury and Federal Reserve. When the COVID pandemic caused market chaos in 2020, the Fed again turned to BlackRock to help manage emergency lending programs. BlackRock was hired to purchase corporate bonds on behalf of the Federal Reserve, essentially becoming the investment arm of the central bank. Think about that for a moment. A private corporation with enormous stakes in publicly traded companies was hired to manage government programs that would affect those same companies. BlackRock was simultaneously invested in companies and helping the government decide which companies to support during the crisis. The conflicts of interest are staggering. BlackRock claimed it had firewalls and procedures to prevent conflicts. But the fundamental structure creates situations where they're on both sides of transactions that move trillions of dollars. And then there's the revolving door between BlackRock and government. Multiple BlackRock executives have taken positions in recent administrations. Brian Deese, a BlackRock executive, became the head of President Biden's National Economic Council. Adewale Adeyemo, BlackRock's former chief of staff, became the deputy treasury secretary. This pattern isn't unique to one party. BlackRock employees have served in Republican and Democratic administrations alike. When you're managing $11 trillion in assets, you get access regardless of who's in power. This access translates to influence over policy. When BlackRock speaks, policymakers listen. Not because BlackRock is bribing anyone or breaking laws, but because they manage an enormous portion of the economy. Their analysis of market conditions matters. Their predictions carry weight. Their concerns about regulatory proposals get serious attention. And because they own stakes in companies across every sector, they can claim to speak for broad economic interests rather than narrow corporate lobbying. They're not just representing one industry, they're representing, in a sense, the entire market. Larry Fink's annual letters to CEOs have become major events in the business world. In these letters, Fink outlines his views on corporate governance, environmental sustainability, stakeholder capitalism, and social responsibility. CEOs read these letters carefully because Fink controls voting power in their companies. When the largest shareholder in your company tells you to focus on climate change or board diversity, you pay attention. This gives BlackRock enormous soft power to shape corporate behavior even without issuing direct orders. But here's where it gets politically complicated. Fink's letters have pushed companies to address climate change, to improve diversity, to think about stakeholder interests beyond just shareholder returns. This has made BlackRock a target for conservative critics who see this as illegitimate political activism dressed up as investment management. Republican-led states have pulled billions of dollars from BlackRock, accusing the firm of boycotting fossil fuels and pursuing environmental, social, and governance goals that hurt returns. Florida, Texas, West Virginia, Louisiana, and other states have divested or refused to do business with BlackRock over ESG concerns. Meanwhile, progressive critics attack BlackRock from the other side. They point out that despite Fink's letters about climate change, BlackRock remains one of the largest investors in fossil fuel companies. Despite talk about stakeholder capitalism, BlackRock has opposed shareholder proposals that would limit executive compensation or give workers more voice in governance. The criticism from both sides suggests that BlackRock's political positioning is more about managing perception than driving real change. They say the right things to avoid regulatory backlash while continuing to invest in whatever makes money. This balancing act extends to media strategy. BlackRock and Vanguard own stakes in both Fox News and CNN, in conservative outlets and liberal outlets, in media properties that cater to every point on the political spectrum. This isn't because they don't have political views, it's because they've figured out that owning all sides is more profitable and less risky than picking one. If you own shares in every major media company, you're insulated from political shifts. When Republicans win elections, your Fox investment does well. When Democrats win, your MSNBC investment thrives. Either way, you profit. This creates a subtle form of control that's more effective than overt censorship. Nobody's telling journalists what to write. But the structure ensures that truly threatening ideas, genuinely disruptive reporting, systematic questioning of the entire economic system, these things have a hard time getting airtime or funding. Because the people who own the platforms have a vested interest in the status quo, they don't need to issue directives. The market does the work for them. Consider how rarely mainstream media discusses the concentration of ownership in media itself. How often do you see Fox or CNN doing deep investigations into how BlackRock and Vanguard's ownership affects editorial independence? How often do major newspapers run series examining whether common ownership by institutional investors reduces competition and innovation in journalism? It happens occasionally, usually in academic journals or alternative outlets, but it's not a major ongoing story, despite being arguably one of the most important structural issues in modern media. The same silence extends to other industries where BlackRock and Vanguard have huge stakes. Airlines, which we mentioned earlier, banking, healthcare, defense. These are sectors where common ownership might be reducing competition, where the same investors owning all the competitors creates incentives against aggressive competition. But these stories don't get sustained coverage on mainstream news networks that are themselves owned in part by those same investors. This isn't a conspiracy in the traditional sense. There's no need for secret meetings or explicit coordination. The structure itself generates the outcome. When media companies know that their largest shareholders also own their advertisers, their competitors, and the companies they might investigate, a certain caution sets in. Not censorship, exactly. More like self-preservation. A recognition that certain stories are dangerous, certain investigations are risky, certain questions threaten the entire ecosystem everyone depends on. The political implications extend beyond media coverage. BlackRock and Vanguard's influence flows into campaign finance, lobbying, and policy advocacy in complex ways. They don't make direct campaign contributions the way individual billionaires do, but they manage pension funds for unions, endowments for universities, retirement accounts for millions of voters. This gives them relationships across the political spectrum. They can't be easily categorized as supporting one party or one ideology because they're embedded in institutions that span every political constituency. This makes them almost immune to traditional political accountability. You can vote out politicians who make bad decisions. You can boycott companies whose practices you oppose. But how do you hold institutional investors accountable when they're managing your retirement money, when your pension fund is invested in their funds, when your university endowment depends on their returns? They've made themselves essential to too many people across too many political divides to be easily challenged. Senator Elizabeth Warren has called for BlackRock to be designated systemically important and subject to federal oversight as too big to fail. Other lawmakers have proposed regulations to limit common ownership or require greater transparency in proxy voting, but these proposals face enormous obstacles. The finance industry argues that regulating asset managers would hurt returns for pensioners and retirees. The asset managers themselves lobby against changes. And because they own stakes in so many companies, they can mobilize business groups across multiple industries to oppose regulation. Meanwhile, their influence over information continues to grow. As traditional media struggles financially, as newspapers close and local news disappears, the media companies that survive are increasingly owned by large corporations that are themselves owned by institutional investors. The same names appear on shareholder lists whether you're looking at the New York Times or local television chains or streaming platforms. The ecosystem is consolidating, and BlackRock and Vanguard are at the center of that consolidation. This doesn't mean they control every story or determine every narrative. Individual journalists still have integrity. Editorial independence still exists in many outlets. Important investigative work still gets published. But the structural pressures are real. The incentives are aligned in ways that favor stability over disruption, that reward safe content over risky investigations, that make questioning the fundamental architecture of power harder than questioning individual bad actors within that architecture. The conspiracy theorists look at this and see puppet masters orchestrating a grand plan. The more sophisticated analysis sees something potentially more concerning. A system that doesn't need puppet masters because the structure itself generates the outcomes that concentrated power prefers. No conspiracy required when the incentives, the ownership structures, the financial interdependencies all point in the same direction. When two firms own stakes in all the companies that create and distribute information, when those same firms have deep relationships with government, when they manage trillions in assets that touch every part of the economy, you don't need shadowy plots. You just need the system to operate exactly as designed. There's a machine you've never heard of that watches over $20 trillion. It processes more financial data in a day than most people will see in a lifetime. It analyzes stocks, bonds, derivatives, currencies, real estate, private equity, everything that moves in global markets. It runs scenarios, calculates risks, predicts outcomes, and guides decisions that affect pension funds, insurance companies, banks, corporations, and governments. It's called Aladdin, and it might be the most powerful piece of software you don't know exists. Aladdin stands for Asset, Liability, and Debt, and Derivative Investment Network. The name is almost deliberately bland, technical, forgettable, but what it represents is extraordinary. This is BlackRock's proprietary risk management and investment platform, and it has quietly become the operating system of modern finance. Over 240 institutions use Aladdin to manage their investments. That includes half of the world's 10 largest. Insurers. Japan's government pension fund, the largest in the world at $1.5 trillion. Major corporations like Apple, Microsoft, and Google use it to manage their corporate treasuries. Even BlackRock's competitors, including Vanguard and State Street, license Aladdin for their own operations. Let that sink in for a moment. Vanguard, BlackRock's primary rival in the asset management space, pays BlackRock to use its risk management technology. State Street, the third member of the Big Three, does the same. When you control the infrastructure that everyone else depends on, when your technology becomes the backbone of how the industry operates, you've achieved a level of influence that transcends traditional competition. You're not just playing the game, you're running the casino. The assets managed through Aladdin exceed $21 trillion. That's roughly 10% of all the stocks and bonds in the world. Every day, this system processes millions of transactions, analyzes countless risk factors, and helps guide investment decisions that ripple through global markets. And it's all happening behind the scenes, invisible to the public, unknown to most people who depend on the financial system functioning properly. Aladdin's origin story takes us back to Larry Fink's $100 million loss at First Boston. That catastrophic mistake haunted Fink, but it also taught him something crucial. The financial industry didn't have adequate tools to understand and manage risk. The models were too simple. The analysis was too shallow. Nobody had built technology sophisticated enough to handle the complexity of modern securities, particularly the mortgage-backed instruments that were proliferating in the 1980s. When Fink and his partners founded BlackRock in 1988, they started building that technology. It began on a single Sun Microsystems workstation, sitting between a refrigerator and a coffee machine in their one-room office. The early developers were Charles Halleck, who would become known as the architect of Aladdin, and Bennett Golub, who helped create the mathematical models. They were building analytics for mortgage-backed securities, trying to understand risks that had destroyed Fink's career at his previous firm. The breakthrough came in 1994 when General Electric hired BlackRock to analyze the troubled mortgage portfolio of Kidder, Peabody & Company, a GE subsidiary. The portfolio was a mess. Nobody could figure out what it was worth or what risks it contained, but Aladdin could. BlackRock's technology cut through the complexity and provided the analysis GE needed. The success of that project proved that what they'd built wasn't just useful for BlackRock, it was valuable to the entire industry. By 2000, BlackRock officially began licensing Aladdin to external clients. The timing was perfect. Financial markets were becoming more complex, derivatives were multiplying, global interconnections were deepening. Risk management was shifting from an afterthought to a central concern, and almost nobody had technology that could handle the scale and sophistication that modern finance required. BlackRock did. Then came 2008, and Aladdin became indispensable. When the financial crisis hit and the global economy teetered on the edge of collapse, regulators and institutions turned to BlackRock because of Aladdin. The U.S. Treasury hired BlackRock to analyze toxic assets worth $130 billion from failed institutions like Bear Stearns and AIG. The Federal Reserve brought in BlackRock to value the portfolios of Fannie Mae and Freddie Mac, the government-backed mortgage giants that had imploded. BlackRock managed the Fed's $1.25 trillion program to purchase mortgage-backed securities. These weren't just consulting contracts. This was BlackRock using Aladdin to help government agencies understand the mess that Wall Street had created. And in the process, BlackRock gained access to information that flowed back into Aladdin's databases. They saw inside failed institutions. They analyzed toxic assets that nobody else could value. They worked directly with regulators and central banks at the highest levels. All of that data, all of those relationships, all of that experience, it made Aladdin more powerful and made BlackRock more essential. After 2008, demand for Aladdin exploded. Every institution realized they needed better risk management. Few had the resources to build comparable systems themselves. BlackRock had the solution ready to license. The client list grew rapidly. Pension funds like CalPERS and CalSTRS, managing hundreds of billions in retirement assets. Banks like Deutsche Bank. Insurers like Prudential. Central banks like the Bank of Israel. Sovereign wealth funds. Asset managers. Corporations. All of them plugging into the same system, using the same risk models, viewing markets through the same analytical lens. Today, Aladdin operates on a network of over 6,000 computers in multiple data centers, including a massive facility in Wenatchee, Washington. The system processes global economic data, stock prices, bond yields, currency movements, weather patterns, political events, anything that might affect investment values. It can simulate thousands of scenarios, stress testing portfolios against potential crises. What happens if interest rates spike? What if oil prices collapse? What if a major currency devalues? Aladdin can model the impacts within minutes. The platform unifies the entire investment process. Portfolio construction, risk analysis, trading, compliance, operations, everything happens in one integrated system. This solves a problem that plagues most large financial institutions: data fragmentation. Different departments using different systems, creating inconsistencies and blind spots. Aladdin provides what BlackRock calls a single version of the truth. One database, one set of analytics. Everyone seeing the same information. This is enormously powerful for institutions trying to manage complex, global investment portfolios. But it's also enormously powerful for BlackRock. Every transaction processed through Aladdin, every risk analysis, every portfolio decision, it all generates data that flows back to BlackRock. The system learns from everything happening on the platform. When CalPERS rebalances their portfolio, Aladdin sees it. When Deutsche Bank stress tests their exposure, Aladdin processes it. When the Bank of Israel adjusts their currency holdings, Aladdin tracks it. BlackRock gains insight into how the world's largest investors are positioning themselves, what they're worried about, where they see opportunities. BlackRock insists there are firewalls preventing conflicts of interest. Client data remains confidential. Information from one client doesn't advantage another. The company has compliance procedures and legal obligations. All of that is probably true, but the structural advantage of operating the platform that everyone else uses is undeniable. You see the flow of the entire market. You understand the positioning of major players. You know what's working and what's not, because you're processing the data that proves it. This creates what economists call information asymmetry. BlackRock knows more than any individual client because BlackRock sees all the clients. Even with perfect firewalls and ethical compliance, the aggregate knowledge, the pattern recognition, the systemic understanding that comes from operating the platform, that's an advantage that can't be fully neutralized. It's like being the exchange rather than just a trader on the exchange. You're providing infrastructure, but you also see everything that happens on that infrastructure. Critics point to another concern: systemic risk. When a large percentage of global assets are managed using the same risk models, responding to the same signals, protected by the same firewalls, what happens if those models are wrong? What happens if Aladdin misses something, if its algorithms fail to anticipate a crisis, if its risk assessments prove inadequate? With $20 trillion following similar logic, the potential for synchronized panic is real. The Los Angeles County Employees Retirement Association, a $58 billion pension fund, explicitly declined to use Aladdin's risk capabilities in 2021, citing concerns about groupthink. If everyone is using the same system, seeing the same risks, reaching the same conclusions, you lose the diversity of perspectives that helps markets function. You create herd behavior at an unprecedented scale. Financial regulators are starting to notice. The UK's Financial Conduct Authority warned in 2021 that the failure of a large portfolio and risk system like Aladdin could cause serious consumer harm or damage market integrity. The concern isn't that Aladdin will fail technically, though that's possible. It's that reliance on a single system creates concentration risk. If something goes wrong, if hackers breach the network, if a software error causes widespread miscalculations, if geopolitical events shut down data centers, the effects could cascade through the global financial system, and there's no real alternative. Competitors exist, but none have Aladdin's scale, sophistication, or market penetration. Building a comparable system would cost billions and take years. By the time anyone caught up, Aladdin would have evolved further. BlackRock has spent 35 years developing this technology, and they continue investing heavily. In recent years, they've poured resources into artificial intelligence and machine learning, training models on decades of financial data to improve predictions and automate analysis. Larry Fink has credited this AI integration with enabling BlackRock to manage an additional $2.5 trillion in assets with the same headcount, a stunning example of technology-driven productivity. The integration of AI makes Aladdin even more powerful, but also more opaque. Machine learning models are notoriously difficult to interpret. They find patterns that humans can't see, correlations that aren't obvious. This black box quality raises questions about accountability. If Aladdin's AI recommends a certain investment strategy, if it flags specific risks, if it guides decisions that affect millions of people's retirement savings, who can verify that those recommendations are sound? Who checks the algorithm's work? BlackRock emphasizes that Aladdin doesn't make decisions. It provides analysis and recommendations, but humans make the final calls. That's technically true, but it understates technology's influence on human decision-making. When a sophisticated system backed by BlackRock's reputation tells you that a certain risk level is acceptable, most people trust that assessment. When Aladdin suggests that a particular portfolio adjustment will improve outcomes, portfolio managers usually follow that guidance. The technology shapes decisions, even when it doesn't formally make them. There's also the conflict of interest that comes from BlackRock being both an asset manager and a technology provider. When Aladdin spots risk in a client's portfolio, when it identifies gaps in asset allocation, BlackRock is perfectly positioned to offer solutions. Need more exposure to emerging markets? BlackRock has ETFs for that. Concerned about interest rate risk? BlackRock can help with that too. The platform creates sales opportunities for BlackRock's investment products. It's a built-in advantage that competitors licensing the technology help subsidize. Government relationships add another layer. When central banks and regulators use Aladdin, when they rely on BlackRock's analysis during crises, it creates intimacy between the company and the institutions that are supposed to oversee the financial industry. During COVID, the Federal Reserve again hired BlackRock to manage emergency bond buying programs. BlackRock was essentially operating as an extension of the central bank, using Aladdin to implement monetary policy. The revolving door between BlackRock executives and government positions reinforces these connections. All of this happens with minimal public scrutiny. Aladdin isn't a household name. Most people who depend on the financial system have never heard of it. The technology operates behind the scenes, invisible but essential, like plumbing or electrical wiring. You don't think about it until something goes wrong. But unlike physical infrastructure, financial infrastructure is harder to understand, harder to regulate, harder to hold accountable when problems emerge. The conspiracy theories around Aladdin portray it as a puppet master, an algorithm that controls markets, that manipulates economies, that serves as the tool through which BlackRock exercises global domination. That's hyperbole. Aladdin is risk management software, sophisticated and powerful, but ultimately just a tool. It doesn't have agency. It doesn't have goals beyond what its programmers build into it. But the reality is concerning enough without resorting to conspiracy. $20 trillion managed through a single platform, major competitors using technology controlled by their rival, central banks relying on a private company's system during crises, concentration of knowledge, infrastructure, and influence in ways that create systemic vulnerabilities. These aren't theories. These are facts, documented in regulatory filings and financial reports. The question isn't whether Aladdin is evil, it's whether the system should work this way. Whether it's healthy for so much of the global financial infrastructure to depend on one company's technology, whether the benefits of Aladdin's sophistication and scale outweigh the risks of concentration and potential conflicts, whether regulators should have more oversight over critical financial technology, particularly when that technology is used by government agencies themselves. BlackRock argues that Aladdin makes markets safer, that better risk management benefits everyone, that having a common analytical framework improves stability rather than threatening it. They're probably right that Aladdin helps individual institutions manage their portfolios better, but systemic stability is different from individual optimization. What's good for each institution separately might create collective risks that nobody intended. This is the challenge of complex systems. Nobody designed the financial system to concentrate so much processing power in one platform. It happened organically as institutions made individual decisions that made sense at the time. BlackRock built good technology. Clients wanted that technology. Competitors found it easier to license than to build their own. Regulators turned to BlackRock during crises because they had the tools nobody else had. Each step was logical. The end result is a structure that nobody would have designed intentionally, but that now exists and is deeply embedded. Unwinding that concentration would be enormously difficult and expensive. Institutions have integrated Aladdin into their operations over years or decades. Switching would require rebuilding systems, retraining staff, potentially accepting inferior analytics during the transition. The switching costs are so high that Aladdin has become effectively locked in for most users. This gives BlackRock pricing power and market dominance that's hard to challenge even if better alternatives emerged. And so Aladdin continues growing. More institutions adopt it, more assets flow onto the platform. The network effects get stronger, the data gets richer, the AI gets smarter. The system becomes more entrenched, more essential, more impossible to imagine functioning without. $20 trillion today. How much in 5 years? In 10? At what point does the concentration become so extreme that regulators have no choice but to intervene? Or has that point already passed, with a system too important to risk disrupting? These are the questions that should keep people awake at night. Not because BlackRock is evil, but because power, this concentrated infrastructure, this essential, operating with this little oversight or public understanding, creates risks that transcend any individual company's intentions. Aladdin represents the future of finance, a world where algorithms process more money than human minds can comprehend, where decisions affecting billions of people are guided by code that few can audit or question. It's efficient, it's sophisticated, it's profitable, and it's terrifying in ways that most people will never realize until something goes catastrophically wrong. Here's where things get truly strange. If you look up who owns BlackRock, you'll find Vanguard near the top of the list, holding about 9% of BlackRock's shares, making it the largest shareholder. Now look up who owns Vanguard. Well, that's where it gets complicated. Vanguard claims it's owned by its funds, which are owned by investors in those funds. But if you dig into those funds, you'll find that many of them hold shares in BlackRock, and BlackRock's funds hold shares in Vanguard's funds. And State Street holds shares in both BlackRock and Vanguard. And BlackRock and Vanguard both hold shares in State Street. It's a circular ownership structure that seems to loop back on itself infinitely, creating a web so tangled that finding the actual top of the pyramid becomes impossible. This isn't conspiracy theory speculation. This is documented in public filings. Vanguard Group owns approximately 9.04% of BlackRock, making it the single largest shareholder in the world's largest asset manager. BlackRock itself owns around 6.3% of its own shares through various funds. State Street owns about 4%. Other institutional investors make up the rest, but if you trace those investors back, you often find the same names reappearing. The big three own each other, own themselves, own the companies that own them. It's ownership inception, layers folding back on themselves in ways that defy traditional understanding of corporate structure. Let's start with BlackRock's ownership. As a publicly traded company, BlackRock has clear shareholder disclosures. Institutional investors own roughly 80% of the company. The top shareholders read like a who's who of asset management. Vanguard at 9%, BlackRock's own funds at 6%, State Street at 4%, Bank of America, Temasek Holdings, and various other funds and institutions filling out the rest. But here's the thing, most of those other institutional shareholders are themselves owned or managed by the same circle of firms. It's not that 5 or 10 completely independent entities own BlackRock. It's more like 3 or 4 major players owning it through various subsidiary structures and fund vehicles, creating the appearance of diversity that doesn't really exist. Vanguard's ownership is where things get genuinely weird. Unlike BlackRock, Vanguard isn't publicly traded. It has a unique mutual ownership structure where the funds themselves own the management company. When you invest in a Vanguard fund, you technically become a partial owner of Vanguard itself. This sounds democratic and decentralized, investors owning the company that manages their money. But in practice, it creates a circular logic that's hard to penetrate. Who owns Vanguard? The funds do. Who owns the funds? The investors do. Who are the investors? Millions of people and institutions. But those institutions are often managed by BlackRock, State Street, and other asset managers. And those asset managers hold Vanguard funds. So Vanguard is owned by funds that are owned by investors that include institutions that hold Vanguard funds. The circularity makes it nearly impossible to identify who actually controls Vanguard in any meaningful sense. This structure also makes Vanguard remarkably opaque. Because it's not publicly traded, it doesn't have the same disclosure requirements as BlackRock. Because it's mutually owned, there's no clear ownership hierarchy to trace. Who makes decisions at Vanguard? The board of directors, elected by representatives of the funds. Who are those representatives? That information isn't readily available to the public. The whole structure is designed to diffuse ownership so thoroughly that pinpointing control becomes an exercise in futility. Critics argue this opacity is convenient. It allows Vanguard to operate with enormous influence while avoiding the scrutiny that comes with being a publicly traded company or having identifiable majority shareholders. It can claim to serve only its investors' interests, because technically the investors are the owners. But those investors are passive. They're not exercising control in any active sense. They're just holding funds. The people actually running Vanguard, the executives and board members, they operate with remarkably little accountability given the trillions of dollars under management. Now layer in State Street, the third member of the big three. State Street is publicly traded like BlackRock. And if you look at State Street's largest shareholders, you find Vanguard and BlackRock right at the top. Vanguard owns about 8% of State Street. BlackRock owns around 7%. State Street's own funds own another chunk. The same circular pattern emerges. The big three own each other in varying proportions, creating a web of cross-ownership that mathematically loops back on itself. This cross-ownership isn't illegal. It's not even unusual in the age of index funds. When you run funds that track the entire market, you inevitably own shares in other asset managers. If BlackRock has an S&P 500 fund, that fund will own shares in BlackRock itself, because BlackRock is in the S&P 500. The same logic applies to Vanguard owning BlackRock and BlackRock's funds owning competitors. It's an automatic consequence of passive investing at scale. But automatic doesn't mean benign. The effect of this cross-ownership is to blur the lines between competition and cooperation. Are BlackRock and Vanguard really competitors if they're major shareholders in each other? Do they compete as aggressively as they would if they were truly independent? When Vanguard makes decisions as BlackRock's largest shareholder, when BlackRock holds Vanguard funds in its portfolios, when both own significant stakes in State Street, the competitive dynamics get muddy. Economic theory suggests that cross-ownership reduces competition. If Company A owns shares in Company A benefits when Company B does well, even if that success comes at Company A's expense. This creates incentives against aggressive competition. You don't want to destroy a rival if you profit from that rival's success. Applied to the big three, this means they have incentives to maintain a stable oligopoly rather than engaging in cutthroat competition that might benefit investors through lower fees or better services. And there's evidence this is happening. Despite claims of intense competition in asset management, the big three have maintained remarkable stability in their market positions. They're not undercutting each other on fees the way you might expect in a truly competitive market. They're not poaching each other's clients aggressively. They seem to coexist comfortably, each growing as the industry grows, without the kind of disruption you'd see if they were genuinely trying to destroy each other. The cross-ownership also creates voting entanglements that are hard to untangle. When Vanguard votes BlackRock's shares, it's voting on a company that holds Vanguard funds. When BlackRock votes shares in companies where Vanguard is also a major shareholder, they're indirectly affecting each other's investments. The web of mutual influence is so complex that tracking cause and effect becomes nearly impossible. You can't isolate BlackRock's interests from Vanguard's interests from State Street's interests because they're all intertwined through layers of cross-ownership. This brings us to the question that conspiracy theorists fixate on. If these companies own each other, who really owns them? The technical answer is that they're ultimately owned by millions of individual investors through pension funds, retirement accounts, and mutual funds. But those individual investors have no meaningful control. They don't vote on major decisions. They don't set strategy. They just hold shares and hope for returns. The actual control rests with the executives and boards of these companies, who operate with remarkable autonomy despite managing trillions of dollars that belong to other people. And here's where the ownership loop creates a genuine problem for accountability. If something goes wrong, if one of these companies makes decisions that harm investors or create systemic risks, who's responsible? The executives will say they were acting as fiduciaries for investors. The investors will say they trusted the executives to manage responsibly. The board will say they provided oversight within the limits of their information and authority. The circular ownership structure allows responsibility to diffuse across so many layers that pinpointing accountability becomes almost impossible. This is fundamentally different from traditional corporate ownership. When a company has a controlling shareholder, a family or a founder or a private equity firm with majority stake, you know who's in charge. If that company does something problematic, you can point to the controlling shareholder and demand answers. But with the big three's cross-ownership and dispersed ownership structures, there's no clear controlling party. It's ownership by everyone and therefore by no one. Power without a face. Influence without a name. The structure also makes hostile takeovers or external challenges nearly impossible. BlackRock can't be acquired by a rival because its largest shareholders are Vanguard and its own funds, who have no interest in selling. Vanguard can't be acquired at all because it's not a traditional corporation with shares to buy. State Street is theoretically vulnerable, but BlackRock and Vanguard's combined ownership would make any hostile bid extremely difficult. The big three have effectively locked themselves into a stable arrangement that external forces can't easily disrupt. Some defenders of this system argue that cross-ownership actually promotes stability. If asset managers have stakes in each other, they have incentives to support the industry's health rather than engaging in destructive competition. They'll work together on issues like regulatory compliance, technology standards, and market infrastructure. This cooperation could benefit the entire financial system by preventing the kind of cutthroat competition that leads to corners being cut or risks being taken inappropriately. But stability can also mean stagnation. It can mean an industry that's comfortable, that's not being pushed to innovate or improve. When the biggest players are all interconnected through ownership and mutual interests, when they all benefit from the status quo, where's the pressure for change? Where's the creative destruction that capitalism is supposed to provide? The cross-ownership creates a cushion that protects incumbents from disruption, and that protection comes at the expense of potential innovations that might serve investors better. There's also the political dimension. When you can't clearly identify who owns and controls the most powerful financial institutions in the world, it becomes very difficult to hold anyone accountable through political or regulatory means. Activists can't target specific billionaires or families because there aren't any pulling the strings. Regulators can't threaten to break up ownership structures that are already so diffuse and circular that breaking them up might be meaningless. The system has evolved a form of protection through complexity. The cross-ownership loop also extends beyond just the big three themselves. Remember, these companies are major shareholders in virtually every large corporation, which means those corporations are, in a sense, also owned by entities that own each other. Apple, Microsoft, ExxonMobil, Pfizer, all of them have BlackRock, Vanguard, and State Street as top shareholders. Those top shareholders own each other. So in some abstract but real sense, corporate America owns itself through this web of institutional cross-ownership. The companies own the asset managers, who own the companies who own the asset managers. It's a closed loop. This creates what some academics call a permanent governing board for corporate America. The big three show up in boardrooms across every industry, not as direct operators, but as major shareholders with voting power. They move between companies, carrying influence from one to another. They create a connective tissue that links supposedly independent corporations into a broader network. And because they own each other, that network has no clear outside. It's self-contained, self-reinforcing, resistant to external challenges. The mathematical reality of this ownership structure is that tracing it to any ultimate endpoint is impossible. You can follow the chain of ownership indefinitely without reaching a conclusion. BlackRock is owned by Vanguard and others. Vanguard is owned by funds. Those funds are owned by investors. Those investors include institutions. Those institutions are managed by BlackRock and others. BlackRock is owned by Vanguard. The loop continues infinitely. It's like an Escher painting where the stairs always lead back to where you started. This isn't how capitalism is supposed to work. In theory, there should be ultimate owners, individuals or entities who bear the final responsibility for investment decisions. There should be a chain of accountability that runs from the frontline portfolio manager up through the organization to whoever ultimately owns and controls the company. But with the Big Three's cross-ownership structure, that chain doesn't exist. It's replaced by a web where everyone owns pieces of everyone else, and nobody owns enough of anything to truly control it, yet somehow these institutions collectively wield enormous power. The defenders will say this is fine, even optimal. Dispersed ownership prevents any single entity from having too much power. The cross-ownership creates aligned incentives for stability and cooperation. The structure has emerged naturally from the growth of index investing and shouldn't be viewed with suspicion. And maybe they're right. Maybe this is just how modern finance works at scale, and concerns about circular ownership are overblown. But it's also possible that we've created something unprecedented and potentially dangerous. A financial structure where the largest players are so interconnected that they function as a single entity while maintaining the appearance of competition. Where ownership has become so circular and complex that accountability has effectively disappeared. Where power is concentrated but can't be located. Where influence is enormous but can't be challenged because it's dispersed across millions of nominal owners who have no real control. The conspiracy theorists look at this and see a deliberate scheme, a plan to create unassailable power through complexity. The more likely explanation is that this structure emerged accidentally, each step logical in isolation but combining into a whole that nobody intended. BlackRock went public to raise capital. Vanguard chose mutual ownership to keep costs low. Index funds automatically bought shares in other asset managers because they're in the indexes. The cross-ownership wasn't designed, it evolved. But evolved structures can be just as consequential as designed ones, sometimes more so because nobody thought through the implications. And here we are, living in a world where asking, who owns BlackRock and Vanguard, leads you down a rabbit hole that circles back on itself. Well, the answer is simultaneously clear in technical terms and impossible to pin down in practical ones. They're owned by millions of investors. They're owned by each other. They're owned by nobody. They're owned by the system itself. All of these answers are true, and none of them are satisfying, because what we're really asking isn't just about legal ownership. We're asking about power, control, accountability, and on those questions, the circular ownership structure provides no answers at all. Let's talk about something closer to home. Literally. The house you live in, the rent you pay, the mortgage that keeps you up at night. BlackRock and Vanguard's reach extends there too, but not in the way you might think. The conspiracy narrative says they're buying up every single family home in America, turning an entire generation into permanent renters. The reality is more complicated, more subtle, and in some ways more concerning precisely because it's harder to see. First, let's address the viral claim directly. No, BlackRock is not going door to door buying individual houses. They're not the ones who outbid you on that starter home you wanted. BlackRock has stated explicitly and repeatedly that they do not purchase individual single-family homes in the United States. This isn't a secret. It's on their website. It's in their public statements. It's verifiable fact. But like many things with BlackRock and Vanguard, the truth is more complex than a simple yes or no. What BlackRock does do is invest heavily in mortgage-backed securities. Remember those? The financial instruments that nearly destroyed the global economy in 2008? They're packages of mortgages bundled together and sold to investors. When you get a mortgage from a bank, there's a good chance that mortgage gets packaged with thousands of others and sold to institutional investors. BlackRock is one of the largest buyers of these securities. So while they don't own your house, they might own the financial instrument that represents your debt. They profit when you make your mortgage payment, even though you'll never know they're involved. This matters because it means BlackRock has enormous influence over the mortgage market without directly touching individual homes. They're investing hundreds of billions of dollars in mortgage securities, providing capital that banks use to make loans. This makes them a crucial part of the housing finance system. If BlackRock decided to pull back from mortgage-backed securities, mortgage rates would spike. Fewer people could afford homes. The market would seize up. They're embedded in the infrastructure of how Americans buy houses, invisible but essential. BlackRock also invests in companies that build new housing. They provide financing for large-scale residential construction projects, particularly purpose-built rental communities. These are developments designed from the ground up to be rental properties, not individual homes that get converted. BlackRock frames this as adding to housing supply, addressing demand for rental housing. And maybe that's true, but it's also true that when you finance the construction of rental housing rather than homes for purchase, you're investing in a future where more people rent permanently rather than building equity through home ownership. Then there's the multifamily sector, apartment complexes, large residential buildings. This is where institutional investors like BlackRock and Vanguard have massive positions. They invest in real estate investment trusts that own and operate apartment buildings across the country. When you rent an apartment, there's a decent chance the building is owned by a REIT that counts BlackRock and Vanguard among its largest shareholders. You're paying rent that generates returns for their funds. And here's where the confusion with Blackstone comes in. Yes, Blackstone, not BlackRock. Different companies easily confuse names. Blackstone, the private equity firm, has been a major buyer of single-family homes. They acquired Home Partners of America in 2021, a company that owned over 17,000 homes. Blackstone backed Invitation Homes, which owns more than 80,000 single-family rental properties across the United States. This is what people are actually seeing when they notice institutional investors buying homes in their neighborhoods. It's primarily Blackstone and similar private equity firms, not BlackRock or Vanguard directly. And this is crucial, BlackRock and Vanguard own shares in these companies. They're major investors in Invitation Homes, in American Homes for Rent, in other large single-family rental operators. So while they're not buying houses themselves, they're profiting from the companies that are. It's one degree of separation, but the connection is real. Their funds benefit when corporate landlords raise rents, when housing remains scarce, when home ownership becomes more difficult and rental demand increases. Let's look at the numbers honestly. Institutional investors own a small percentage of total single-family homes nationally. Estimates range from 1 to 3%. That's not nothing, but it's not 50% or even 20%. Most homes in America are still owned by individuals and families. The conspiracy narrative of Wall Street owning everything is exaggerated, but that doesn't mean there's no problem. Because even small percentages matter enormously when concentrated in specific markets. In certain cities, particularly in the Sun Belt, institutional ownership is much higher. In some neighborhoods in Phoenix, Charlotte, Atlanta, institutional investors bought 30% or more of available homes during peak periods. When that much purchasing power enters a local market, it distorts prices, it drives up costs, it makes it harder for regular buyers to compete. A family trying to get a mortgage can't match an institutional investor offering all cash, no inspection, close in a week. The institutional buyers have advantages that individual purchasers can't overcome. And once institutional investors own significant portions of housing stock in an area, they can influence rents. When corporate landlords dominate a market, they don't have to explicitly collude to push rents higher. They just need to watch what each other is charging and match it. Research has found that corporate landlords charge 15 to 22% higher rents than small individual landlords. Part of this is professionalization and services, but part of it is market power. When your landlord is a corporation answering to shareholders demanding returns, maximizing rent becomes the priority over maintaining affordable housing. There's also the fee structure. Corporate landlords are notorious for fees that small landlords don't charge. Late fees, application fees, pet fees, amenity fees, fees for everything. A 2022 study found that tenants of corporate landlords pay significantly more in fees than tenants of individual landlords. These fees add up, making housing more expensive in ways that don't show up in headline rent numbers. And who benefits from this fee income? The companies charging them, and by extension, the institutional investors like BlackRock and Vanguard who own shares in those companies. The conspiracy theorists look at this and see a deliberate plan. The World Economic Forum's infamous phrase, "You'll own nothing and be happy," gets invoked. The claim is that elites are engineering a future where ordinary people become permanent renters, paying forever to landlords they can never escape. While that specific claim is overblown and misrepresents what the WEF actually said, the underlying trend is real. Home ownership rates have been declining. More Americans are renting for longer periods. Wealth inequality is growing, and housing is a major driver because home ownership is how most middle-class families build wealth. When institutional investors buy homes that would otherwise go to first-time buyers, they're not just affecting who lives in those specific houses. They're affecting wealth building for generations. A family that buys a home builds equity over decades. That equity funds retirement, helps kids with college, gets passed down. A family that rents builds no equity. The money goes to the landlord, who builds equity. Over 30 years, this difference compounds into hundreds of thousands of dollars in wealth disparity. And when the landlord is a corporation owned by institutional investors, that wealth flows to large funds that are already managing trillions. BlackRock and Vanguard's influence on your housing situation goes beyond just ownership of homes or rental companies. Remember, they're also major shareholders in banks. They own significant stakes in Wells Fargo, Bank of America, JP Morgan Chase, Citigroup. These banks make most of the mortgages in America. They set lending standards, interest rates, approval criteria. When BlackRock and Vanguard are major shareholders in all the big banks, they have influence, however indirect, over how accessible mortgages are, how expensive borrowing is, who gets approved, and who gets denied. They also own shares in construction companies, in building material suppliers, in real estate agencies, in mortgage services, in property management firms. The entire housing ecosystem, from construction to purchase to management, includes companies where BlackRock and Vanguard show up as major institutional investors. They're not controlling any single aspect, but they're present in every aspect. It's systemic influence rather than direct control, which makes it harder to point to specific harms, but doesn't make the concentration of interests less real. Consider the incentives this creates. If you're a major investor in both rental companies and mortgage services, do you want housing to be abundant and affordable? Or do you want it scarce enough that prices and rents stay high, generating better returns? If you own shares in construction companies and also in REITs that benefit from housing scarcity, where do your interests actually lie? The conflict isn't always explicit, but the structural incentives point toward preferring constrained supply and high prices over abundance and affordability. This doesn't require conspiracy. It just requires rational actors maximizing returns within the system, if restricting supply through zoning, if limiting new construction. If keeping housing tight generates better returns for your portfolio, that's what fiduciary duty suggests you should support. Not through illegal collusion, but through lobbying, through industry groups, through the normal channels of political influence that large investors use. And because BlackRock and Vanguard own pieces of the entire housing industry, their interests align with higher prices across the board. Your grocery bill is affected too. BlackRock and Vanguard are major shareholders in every large supermarket chain and food producer. Kroger, Albertsons, Walmart, Target, Costco, they're in all of them. Same pattern as housing and media. When the same institutional investors own competing grocery chains, do those chains compete as aggressively on price? Or do they tacitly accept higher margins, knowing their common shareholders benefit either way? Research on common ownership suggests it reduces price competition, and food prices have been rising, faster than general inflation. Energy costs? BlackRock and Vanguard own major stakes in oil companies, utilities, renewable energy firms. Your electricity bill, your gas bill, your heating costs, they all flow partly to companies where these institutional investors are major shareholders. Same with healthcare. Pharmaceutical companies, insurance companies, hospital chains. BlackRock and Vanguard own pieces of all of them. The medications you take, the insurance premiums you pay, the hospital bills you receive, they all connect back to corporations where the same two firms are among the largest shareholders. This is the subtle but pervasive influence that makes BlackRock and Vanguard's reach so concerning. They're not directly setting prices or making specific decisions about your life. But they're major investors in every company that does make those decisions. They vote shareholder proxies. They meet with management. They express views on strategy and priorities. And across every sector, their interests align with higher prices, higher rents, higher costs, because that's what generates returns for their funds. The defender's argument is that this is just capitalism working. Investors invest. Companies maximize profits. That's the system. BlackRock and Vanguard are just doing what all investors do, but at larger scale. And because they're passive index investors, they're not even actively choosing these companies. They're just tracking the market. If there's a problem, it's with capitalism itself, not with specific firms following capitalist logic. There's truth to that. The system does incentivize this behavior. But scale matters. When two firms manage $19 trillion, when they're top shareholders in nearly every major corporation, when their interests span every sector of the economy, the concentration of influence creates effects that didn't exist when ownership was more dispersed. The rules were written for a different era. The system has evolved in ways that concentrate power while maintaining the appearance of competition and market forces. And you feel it in your daily life, even if you don't see the connection. The house you can't afford has institutional investors among its ultimate owners or beneficiaries. The rent that keeps rising flows to companies where BlackRock and Vanguard are shareholders. The groceries, the energy, the healthcare, all more expensive, all providing returns to funds that these firms manage. It's not that they caused all of this. Many factors drive housing costs and inflation, but they benefit from it. They're positioned to profit from scarcity, from high prices, from financial pressure on ordinary people. And that positioning is not accidental. It's the logical result of being the largest investors in everything. The question is whether this is the system we want. Whether it's healthy for two firms to have stakes in your landlord, your bank, your grocery store, your utility company, your pharmacy, all simultaneously. Whether the concentration of economic interest is sustainable, or whether it's creating tensions that will eventually break. Because what works for institutional investors maximizing returns doesn't always work for families trying to build stable lives. Sometimes those interests diverge sharply. And when they do, when the conflict becomes open rather than hidden, the people with $19 trillion in assets tend to have more power than the people paying rent and buying groceries. This is how ownership without ownership works in practice. You don't feel controlled. You're making choices. But the landscape of choices has been shaped by entities you can't see. The prices you pay, the options available, the financial pressures you face, they're all influenced by decisions made in boardrooms where BlackRock and Vanguard have voting power. Not complete control, but influence. Persistent, systemic, accumulated across every sector. And it adds up to a world where two firms are connected to almost every economic transaction you make, whether you realize it or not. The reach of BlackRock and Vanguard doesn't stop at American borders. In fact, their domestic dominance is only part of the story. These firms operate in 70 countries. They manage assets in over 100 nations. They have offices across Europe, Asia, Latin America, the Middle East, and Africa. When we talk about BlackRock and Vanguard controlling the economy, we're not just talking about the American economy. We're talking about the global economic system itself. BlackRock has positioned itself as what some critics call the fourth branch of government, not just in the United States, but increasingly in countries around the world. When Greece faced its debt crisis, BlackRock was there advising on asset sales and restructuring. When Ukraine needed help planning its post-war reconstruction, BlackRock's CEO met with President Zelensky to coordinate the company's role. When China opened its financial markets to foreign asset managers, BlackRock was the first to receive approval to operate a wholly owned mutual fund business in the country. This isn't a company that just invests. This is a company that shapes how nations develop, how governments function, how entire regions organize their economies. Look at Europe. BlackRock and Vanguard are among the largest shareholders in virtually every major European corporation. In Germany, they're top investors in all 30 companies in the DAX index, the country's benchmark stock market. Deutsche Bank, Commerzbank, Siemens, Volkswagen, Bayer, BASF, they all have BlackRock and Vanguard as major shareholders. The same pattern appears in France with the CAC 40 companies, in the United Kingdom with FTSE constituents, across Switzerland, Netherlands, Sweden, Spain, Italy. Pick any major European economy, look at its biggest companies, and BlackRock and Vanguard will be there among the top institutional investors. This creates fascinating dynamics. When Bayer, the German pharmaceutical and chemical giant, acquired Monsanto, the American agricultural biotechnology company, who were the major shareholders on both sides of that transaction? BlackRock and Vanguard. They owned significant stakes in Bayer. They owned significant stakes in Monsanto. The $66 billion mega merger that created the world's largest agrochemical company was a transaction where the same institutional investors held pieces on both sides they couldn't lose. Whether the deal succeeded or failed, whether it created value or destroyed it, BlackRock and Vanguard would own the result either way. The same cross-ownership appears across European industries. Energy companies like BP, Shell, Total, pharmaceutical companies like Novartis, Roche, AstraZeneca, banks like HSBC, BNP Paribas, Santander, automotive companies like BMW, Mercedes, Renault, luxury goods makers like LVMH and Richemont, technology firms, telecommunications companies, food producers, airlines. The pattern is relentless and consistent. BlackRock and Vanguard appear on shareholder lists of Europe's corporate champions, exerting influence through voting rights and stakeholder engagement. European regulators are starting to notice. The concentration of ownership by American asset managers in European companies raises sovereignty questions. If the largest shareholders in German industry are American firms, if French corporate strategy is influenced by American institutional investors, if British banking is partly governed by American asset managers, what does that mean for European economic independence? These aren't hypothetical concerns. There are active debates in European capitals about whether allowing such concentrated foreign ownership threatens national interests. BlackRock's response has been to emphasize its local presence and fiduciary duties. They have European offices staffed with European professionals. They vote shares based on local governance codes and market practices. They're managing money for European pension funds and insurance companies, not just American clients. All of this is true, but it doesn't fully address the underlying issue, which is structural. When the same firms own significant stakes across competing companies in the same industries across multiple countries, the potential for conflicts and coordinated influence exists regardless of intentions or national loyalties. Now turn to Asia, where the dynamics get even more complex. BlackRock operates across developed Asian markets like Japan, South Korea, Singapore, Hong Kong, and Australia. But they've also aggressively expanded into emerging Asian economies, particularly China and India. The China push has been especially controversial. BlackRock became the first foreign asset manager to receive Chinese government approval to operate a wholly owned mutual fund business in the country. This was a significant breakthrough, giving BlackRock direct access to Chinese retail investors and the massive pool of Chinese savings. Critics, including prominent investors like George Soros, called BlackRock's China expansion a tragic mistake that could threaten national security. The concern is that by helping channel Western capital into Chinese markets, BlackRock is effectively funding a geopolitical rival. Chinese companies that benefit from BlackRock's investments include state-owned enterprises with ties to the Chinese military, surveillance technology firms involved in human rights abuses, and companies supporting China's strategic ambitions in areas that conflict with Western interests. BlackRock's defense is that capital flows are global, that investors deserve access to the world's second-largest economy, and that engagement rather than isolation is the right approach. But the critics note that BlackRock's investments in China are not just passive index holdings. The company has actively promoted Chinese assets to clients, downplayed political risks, and maintained relationships with Chinese authorities that require careful navigation of a political environment hostile to Western values. The Japan connection is particularly important given that country's massive institutional investor base. Japan's government pension investment fund, the largest pension fund in the world with over $1.5 trillion in assets, uses BlackRock services. This gives BlackRock insight into and influence over how Japan's retirement system invests globally. When the world's largest pension fund makes allocation decisions, those decisions move markets. BlackRock's position as an advisor and service provider puts them at the center of those flows. In emerging markets across Asia, Latin America, and Africa, BlackRock and Vanguard's presence creates different dynamics than in developed economies. These markets often lack the regulatory sophistication and institutional strength to oversee foreign institutional investors effectively. When BlackRock enters an emerging market, they're often larger than domestic players, have more advanced technology, more experience, and more capital. This can crowd out local asset managers and create dependencies where national savings flow through foreign-controlled channels. Latin America presents a case study. BlackRock and Vanguard have substantial investments across the region. Brazil, Mexico, Chile, Colombia, Argentina all see significant inflows from these firms. They invest in local companies, government bonds, real estate. They provide capital that supports development but also create relationships that can influence policy. When BlackRock holds large positions in a country's sovereign debt, that country's finance ministry pays attention to what BlackRock thinks. When Vanguard is a major investor in a nation's largest companies, those companies factor Vanguard's preferences into their strategies. Central banks represent another layer of global influence. Multiple central banks around the world use BlackRock's Aladdin platform for their reserve management. The Bank of Israel uses it. Other central banks, particularly in smaller economies, license the technology. This creates a situation where a private American company provides the risk management infrastructure for national monetary authorities. BlackRock sees the positioning of central bank reserves, understands how monetary authorities are thinking about risks and profits from providing the tools they use to make decisions. The relationship between BlackRock and central banks goes beyond technology. During the 2008 financial crisis, the U.S. Federal Reserve hired BlackRock to help manage distressed assets. During the COVID pandemic, the Fed again turned to BlackRock to implement corporate bond purchases. This pattern of central banks using BlackRock during crises is spreading globally. When there's a financial emergency, when traditional tools aren't working, when central banks need to venture into unconventional territory, they call BlackRock. This has happened not just in the United States, but in Europe and elsewhere. Critics call this too close for comfort. A private company should not be the de facto emergency responder for central banks. The conflicts of interest are too severe. BlackRock manages funds that invest in the same assets the central bank is buying. BlackRock has clients who benefit from central bank policies. BlackRock's own financial performance depends on market conditions that central banks influence. Putting BlackRock in the role of advisor and implementer of central bank programs creates opportunities for information, advantages, and preferential treatment that may be unavoidable even with the best intentions. The war and peace dimension is perhaps most disturbing. BlackRock and Vanguard are major investors in defense contractors globally. American companies like Lockheed Martin, Northrop Grumman, Raytheon, General Dynamics, European firms like Before Anyone Else Systems, Airbus, Leonardo, Thales. They own stakes in arms manufacturers on multiple sides. Of geopolitical rivalries, Russian defense companies before sanctions, Chinese military-industrial firms, Middle Eastern arms dealers. The same institutional investors profit from weapons sold to governments that may someday use those weapons against each other. This raises uncomfortable questions about incentives. If you're a major shareholder in defense companies, do you benefit from peace or from conflict? Defense contractors make money when governments buy weapons. Governments buy more weapons when they feel threatened. Sustained military tensions, regional conflicts, arms races, these create demand for the products that generate returns for shareholders. Nobody's claiming BlackRock and Vanguard are starting wars, but they're certainly positioned to profit from geopolitical instability, and that creates a structural incentive problem that shouldn't be ignored. The energy sector presents similar issues globally. BlackRock and Vanguard own massive stakes in oil and gas companies worldwide. Despite Larry Fink's letters about climate change and sustainability, BlackRock remains one of the largest investors in fossil fuels on the planet. They own pieces of ExxonMobil, Chevron, ConocoPhillips in the United States, Shell, BP, Total in Europe, Petrobras in Brazil, Middle Eastern energy firms. Russian oil companies before sanctions, Chinese state-owned petroleum enterprises. They're invested across the global fossil fuel infrastructure. This creates contradictions between stated climate commitments and actual investment portfolios. BlackRock talks about sustainability and pushes companies toward net zero targets. But they continue investing hundreds of billions in fossil fuels. They vote against shareholder proposals that would meaningfully restrict oil and gas production. They oppose regulations that would seriously threaten the profitability of energy companies in their portfolios. The disconnect between rhetoric and reality has made BlackRock a target for both. Environmental activists who say they're not doing enough, and conservative critics who say they're pushing a political agenda. Infrastructure represents another arena of global influence. BlackRock has made massive investments in infrastructure assets worldwide. Power plants, toll roads, airports, seaports, telecommunications networks, water systems. These are the physical backbones of modern economies. When BlackRock owns stakes in critical infrastructure, they're not just passive investors. They influence how that infrastructure is operated, how it's maintained, who has access, what it costs. In some cases, they're literally controlling assets that nations depend on to function. In 2024, BlackRock made a $40 billion acquisition targeting data centers, the infrastructure of the digital economy. This follows their pattern of seeking ownership in essential systems. Data centers, like power grids and transportation networks, are infrastructure that everything else depends on. When a single firm accumulates positions across critical infrastructure globally, questions about strategic control and national security inevitably arise. Who decides priorities when infrastructure is owned by foreign investors? What happens during international tensions if critical assets are controlled by entities from rival nations? The sovereign wealth fund relationships add another dimension. BlackRock manages money for sovereign wealth funds from Norway, Singapore, Abu Dhabi, and others. These funds represent national savings, the wealth of entire countries. When BlackRock advises these funds on allocation, when they manage portions of sovereign portfolios, they're influencing how nations deploy their resources. They're shaping investment flows that affect global capital markets. They're in rooms where decisions about hundreds of billions of dollars are made, decisions that can move markets and affect geopolitics. There's also the question of what happens when interests diverge. BlackRock manages money for clients in the United States, Europe, China, and the Middle East simultaneously. These regions have conflicting strategic interests. What happens when American clients want BlackRock to avoid Chinese assets for security reasons, but Chinese regulations require BlackRock to invest locally to maintain their license? What happens when European clients expect divestment from Russian energy, but that conflicts with returns sought by other clients? BlackRock is caught in the middle of every major geopolitical tension, managing assets for parties on all sides. The conspiracy theories paint BlackRock and Vanguard as orchestrators of a new world order, deliberately shaping global events to consolidate power. That's almost certainly overblown. But what's not overblown is their structural position. They are embedded in the financial infrastructure of the global economy at a level no private entities have reached before. They have relationships with governments, central banks, corporations, and institutional investors across every region. They influence capital flows that determine which countries grow and which stagnate, which industries thrive and which decline, which policies get adopted and which get abandoned. This is power without precedent in private hands. It's not political power in the traditional sense. They're not setting tax rates or passing laws. It's economic power, the ability to shape outcomes through control of capital. And because capital is increasingly what determines national success in a globalized economy, economic power translates into real-world influence over how societies develop. When BlackRock has relationships with governments ranging from the United States to China to emerging markets across 3 continents, when they're advising central banks and managing sovereign wealth, when they own stakes in critical infrastructure and defense companies and energy producers globally, they've achieved a form of influence that transcends traditional categories. The question is whether this level of concentrated global financial power in unelected private institutions is compatible with democratic governance and national sovereignty. We're running an experiment in real time. No one designed this system intentionally. It emerged from the growth of index investing, the globalization of capital markets, the rise of institutional investors, and the success of a few firms in capturing dominant market positions. But intentional or not, we now live in a world where 2 American asset management companies have significant ownership stakes in virtually every major corporation across North America, Europe, Asia, and beyond. Where they profit from arms sales on multiple sides of conflicts, where they own pieces of the infrastructure that nations depend on, where they advise central banks and sovereigns on how to manage trillions in national wealth. This is the global power structure of 21st century capitalism. Not governments directly, not individual billionaires, obviously, but institutional investors managing money for millions of clients, using that capital to accumulate stakes across the entire world economy, creating influence that spans borders and sectors in ways that are hard to regulate because they're hard to even comprehend. And at the center of it all, 2 firms, BlackRock and Vanguard, sitting quietly behind nearly everything, everywhere. We've established that BlackRock and Vanguard own pieces of everything. But here's the question that drives conspiracy theorists wild, and that nobody seems able to answer satisfactorily. Who owns BlackRock and Vanguard? If these 2 companies control trillions of dollars in assets, if they're major shareholders in nearly every corporation that matters, if they influence governments and shape global capital flows, then surely someone must own them. Someone must benefit from all that power and wealth. Someone must be at the top of the pyramid, right? The answer is both simple and maddeningly complex. It's technically clear, it's practically impossible to pin down, and the ambiguity itself might be the most disturbing part. Let's start with BlackRock, since it's the simpler case. BlackRock is a publicly traded corporation. You can buy shares of BlackRock stock on the New York Stock Exchange. The company has clear ownership structure documented in public filings. Institutional investors own roughly 80% of BlackRock's shares. Individual investors own the rest. So who owns BlackRock? Well, if you look at the largest shareholders, you find a list that should sound familiar by now. Vanguard Group is BlackRock's largest shareholder, owning approximately 9% of the company. That's right, the biggest competitor owns the biggest chunk. Already, we're in circular territory, but it continues. BlackRock itself, through its own funds, owns around 6% of BlackRock. State Street owns about 4%. Other institutional investors, pension funds, insurance companies, sovereign wealth funds, they make up the rest. But if you trace those institutional investors back, you often find the same names reappearing. Vanguard funds, BlackRock funds, State Street funds. The ownership circle keeps looping back on itself. Now, technically, those shares are owned on behalf of clients. When Vanguard owns 9% of BlackRock, it's not Vanguard's money, it's the money of investors in Vanguard's funds. Those investors include pension funds, which represent millions of workers, endowments representing universities, insurance companies representing policyholders, and individual retirement accounts belonging to regular people. So, in a legal sense, BlackRock is owned by a vast, dispersed group of millions of people who have money in funds that hold BlackRock shares. But here's the problem with that answer. Those millions of people don't actually exercise ownership in any meaningful way. They don't vote the shares. They don't attend shareholder meetings. They don't influence strategy or governance. The voting power rests with the institutional investors who hold the shares on their behalf. Vanguard votes its 9%. BlackRock's own funds vote their 6%. State Street votes its 4%. So while technically the beneficial owners are millions of individuals, the actual control rests with a handful of institutional investors. And who controls those institutional investors? Well, that's where it gets even more complicated. BlackRock is run by its executives and overseen by its board of directors. Larry Fink, as CEO and chairman, wields enormous influence, though he owns less than 1% of the company personally. The board includes representatives from various backgrounds, finance, technology, academia, but they're elected by shareholders, which means they're elected by institutional investors. Which means Vanguard, BlackRock's own funds, and State Street have significant say in who governs BlackRock. This creates a closed loop. BlackRock is governed by a board elected by shareholders that include Vanguard. Vanguard's structure, which we'll get to shortly, makes it opaque who controls Vanguard. BlackRock's own funds own BlackRock, which means BlackRock partially governs itself. State Street is publicly traded with BlackRock and Vanguard as major shareholders. The big three own each other in varying proportions, creating a web where tracing ultimate control becomes an exercise in circular logic. Some defenders of the system say this is actually good. Dispersed ownership prevents any single entity from having too much control. The checks and balances of having multiple institutional investors with their own interests prevents concentration of power. But critics argue the opposite, that this creates a situation where a small number of executives at a small number of firms exercise enormous influence over the entire system while being accountable to no one in particular because ownership is so diffused that organizing shareholders to challenge management is nearly impossible. Now let's tackle Vanguard, where things get truly strange. Vanguard is not publicly traded. It's structured as a mutual company owned by its funds. This means that if you invest in a Vanguard fund, you technically own a piece of Vanguard itself. It sounds democratic and investor-friendly. Jack Bogle designed it. That way, intentionally, creating a structure where the management company exists solely to serve the investors rather than outside shareholders demanding profits. It's elegant in theory, but in practice, it creates an ownership structure so convoluted that pinpointing who actually controls Vanguard is nearly impossible. The funds own Vanguard. The investors own the funds. So the investors own Vanguard. But those investors are millions of people and institutions scattered across the globe. They don't exercise control collectively. They're not organized. They don't vote on Vanguard's strategy or leadership in any direct way. Instead, Vanguard is governed by a board of directors elected by representatives of the funds, who are themselves selected through processes that aren't transparent to the public. Who sits on Vanguard's board? That information is available, but who elects them? How are fund representatives chosen? What power do those representatives actually have? These questions have answers buried in corporate documents and fund prospectuses, but they're not the kind of information that gets widely discussed or easily understood. The structure is deliberately complex, creating layers between the nominal owners, the millions of fund investors, and the people actually making decisions about how Vanguard operates. This opacity has made Vanguard a favorite target of conspiracy theorists. If you can't figure out who owns Vanguard, if the ownership structure loops back on itself in ways that obscure accountability, then it's easy to believe that someone is hiding behind that complexity. The theories range from old money families secretly controlling Vanguard, to intelligence agencies using it as a financial tool, to shadowy globalist elites using Vanguard as a vehicle for consolidating power. Most of these theories are baseless speculation, but the fact that Vanguard's structure makes such speculation possible, that's a real problem. The practical reality is probably more mundane, but still concerning. Vanguard is run by its executives, led by a CEO and senior management team who make day-to-day decisions. They're overseen by a board that's supposed to represent investor interests, but because ownership is so diffused and the structure so complex, those executives operate with remarkable autonomy. They manage over $8 trillion with limited accountability to any identifiable owner because technically everyone and no one owns Vanguard simultaneously. This becomes especially problematic when you remember that Vanguard is the largest shareholder in BlackRock. So Vanguard, a company with no clear ownership, is the biggest owner of BlackRock, which is itself partially owned by its own funds, and by State Street, which is owned by both Vanguard and BlackRock. The circularity is dizzying. It's ownership without owners, control without controllers, power that's simultaneously real and impossible to locate. Let's add another layer. Many of the investors in Vanguard and BlackRock funds are themselves institutional investors. Pension funds, for instance. Who owns pension funds? The workers whose retirement they represent. But those workers don't control the pension fund. It's managed by trustees and investment committees who make allocation decisions. Those committees choose to invest in Vanguard and BlackRock funds. So workers own pensions, pensions own Vanguard and BlackRock funds, Vanguard and BlackRock funds own shares in corporations and in each other. The ownership chain is so long and convoluted that tracing accountability from the ultimate beneficiaries, the workers and individual investors, to the actual decision makers becomes nearly impossible. This is fundamentally different from traditional capitalism. In the past, companies had identifiable owners, families like the Rockefellers or Carnegies, founders like Henry Ford or Thomas Edison. Later, controlling shareholders, or private equity firms. You could point to someone and say, that person owns this company and benefits from its success. With BlackRock and Vanguard, you can't do that. The ownership is atomized across millions of accounts, but the control is concentrated among a few hundred executives and board members who run the institutional investors. Some economists argue this separation of ownership and control is a feature, not a bug. It professionalizes investment management. It prevents individual owners from making irrational decisions based on ego or whim. It subjects capital allocation to fiduciary standards and regulatory oversight. All of that is true to some extent. But it also creates a situation where enormous power is exercised by people who don't bear meaningful personal risk. The executives at BlackRock and Vanguard are compensated well, but they're not betting their personal fortunes. They're managing other people's money, which creates different incentives than risking your own wealth. There's also the question of succession and continuity. When Larry Fink eventually steps down or dies, who takes over BlackRock? The board will select a successor. Who influences that board? The major shareholders, which are Vanguard, BlackRock's own funds, and State Street. When Jack Bogle founded Vanguard, he created a structure intended to outlive him. But who ensures that Vanguard stays true to Bogle's vision? The board and management. And who holds them accountable? Technically, the fund investors. Practically no one, because organizing millions of dispersed investors to challenge entrenched management is nearly impossible. This creates institutional immortality without clear ownership. Companies like BlackRock and Vanguard can persist indefinitely, accumulating power and influence across decades without ever having a single owner or controlling entity that could be held responsible. They become institutions unto themselves, serving their own perpetuation as much as they serve their clients. And because they're embedded so deeply in the global financial system, because so many other entities depend on them, they become too essential to fail and too complex to regulate effectively. The conspiracy theorists look at this and see deliberate obfuscation. They believe powerful interests hide behind the complexity, using layers of corporate structure to conceal their control. Maybe there's a kernel of truth to that. Maybe complexity is convenient for those who benefit from the status quo. But the more likely explanation is that the system evolved this way without anyone designing it, each step logical in isolation but combining into a whole that's nearly incomprehensible. Index funds led to concentrated ownership. Concentrated ownership led to cross-ownership. Cross-ownership led to circular structures. Circular structures led to diffused accountability. And diffused accountability led to a system where enormous power is exercised by institutions that are simultaneously owned by millions of people, and controlled by no one in particular. It's an emergent property of modern finance, not a conspiracy, but almost more troubling because it can't be blamed on anyone specific. So who owns BlackRock and Vanguard? The technical answer, millions of investors through various funds and shares. The practical answer, nobody and everybody simultaneously. The power they wield is real. The influence they have is undeniable. But trying to point to who benefits, who controls, who's ultimately responsible, that's where the system breaks down. It's power without a face, influence without ownership, control that's distributed across so many layers that holding anyone accountable becomes nearly impossible. This might be the most disturbing answer of all. Not that evil masterminds control everything from the shadows, but that the system has evolved beyond anyone's control, that the institutions managing trillions of dollars in assets are accountable primarily to themselves, and that the question of who owns the owners doesn't have a satisfying answer because the structure has become too complex for traditional concepts of ownership to apply. We've created financial institutions that are simultaneously everywhere and nowhere, owned by everyone and no one, powerful beyond measure but ultimately answerable to an abstraction, the market, rather than to any specific humans. In the end, asking who owns BlackRock and Vanguard is like asking who owns the wind. You can describe its effects, you can measure its force, you can predict its direction. But you can't point to an owner. The ownership has been diffused so thoroughly, layered so many times, looped back on itself so completely that the traditional question becomes meaningless. And that might be the entire point. Intentional or not, power that can't be located can't be challenged. Influence that can't be attributed can't be held accountable. And two companies managing $19 trillion, owned by millions, but controlled by few, answerable to everyone and no one, continue growing larger, more essential, more embedded in the fabric of global finance, while the question of who ultimately benefits remains unanswered and perhaps unanswerable. Walk into any supermarket. Look at the shelves. Hundreds of brands, thousands of products. Coca-Cola or Pepsi, Tide or Gain, Dove or Axe, Cheerios or Frosted Flakes. The abundance is overwhelming. The variety seems endless. You're free to choose whatever you want. That's the promise of the free market. competition, options, choice. Except when you look closer, when you trace those brands back to their parent companies, and then trace those parent companies back to their largest shareholders, you find the same two names appearing over and over again. BlackRock, Vanguard. The illusion of choice revealed for what it is. Let's start with food and beverages, the products you interact with every day. Coca-Cola and PepsiCo present themselves as fierce rivals. They run competing ad campaigns. They fight for shelf space. Their products sit side by side, red versus blue, cola wars that have raged for generations. But look at the shareholder lists. Vanguard owns about 8.5% of Coca-Cola. BlackRock owns over 7%. At PepsiCo, Vanguard owns over 9%. BlackRock owns nearly 8%. The two competitors are substantially owned by the same institutional investors. When you choose Coke over Pepsi, you're not really choosing between competitors in the traditional sense. You're choosing between products whose parent companies share the same major shareholders. This pattern repeats across food manufacturers. Nestle, Unilever, Mondelez, General Mills, Kellogg's, Kraft Heinz. Look up any major food company and you'll find BlackRock and Vanguard near the top of the shareholder list. They own stakes in brands that supposedly compete. They profit when you buy Oreos or Chips Ahoy, when you choose Hellmann's or Miracle Whip, when you pick Ben & Jerry's or Haagen-Dazs. The competition is real at the consumer level, companies fighting for your dollars, but at the ownership level, the same investors win regardless of which brand succeeds. Move to personal care products. Procter & Gamble owns dozens of brands. Unilever owns dozens more. Johnson & Johnson has its portfolio. These companies compete across categories: shampoo, soap, toothpaste, deodorant. But Vanguard and BlackRock are major shareholders in all of them. When you choose between brands, when you decide Dove over Dial or Crest over Colgate, you're choosing between products whose manufacturers are substantially owned by the same institutional investors. The shelf space creates an illusion of diversity that the ownership structure contradicts. The technology sector shows the same pattern. Apple, Microsoft, Google, Amazon, Meta. These are supposedly fierce competitors, titans clashing in the digital economy. But they're all substantially owned by BlackRock and Vanguard. When these companies compete for your attention, your data, your spending, the major shareholders benefit from all sides. It doesn't matter if you use an iPhone or Android, Windows or Mac, Google or Bing, Amazon or whatever alternative exists. BlackRock and Vanguard own pieces of all the major players. The competition benefits consumers through innovation and lower prices, maybe. But it certainly benefits the common shareholders who own stakes in every competitor. Pharmaceuticals and healthcare present an even more troubling version of this pattern. BlackRock and Vanguard are major shareholders in Pfizer, Johnson & Johnson, Merck, AbbVie, Bristol-Myers Squibb, and virtually every other major pharmaceutical company. They're also major shareholders in CVS, Walgreens, and other pharmacy chains. And they own stakes in health insurance companies like United Health, Anthem, and Cigna. They're invested across the entire healthcare value chain: the drug manufacturers, the distributors, the retailers, the insurers. Every dollar spent on healthcare flows through companies where BlackRock and Vanguard are major shareholders. This creates perverse incentives. If you own both pharmaceutical companies and insurance companies, do you want healthcare to be affordable? Or do you want drug prices high enough to generate returns for the manufacturers, while insurance premiums rise to cover those costs, generating returns for the insurers? If you own both the companies making drugs, and the companies dispensing drugs, and the companies paying for drugs, your interest is in the overall system remaining profitable, not in any individual part of the system being efficient or affordable. The alignment of ownership across competing and complementary companies in the same sector creates incentives that don't serve consumers. Airlines provide a case study that economists have actually researched. BlackRock and Vanguard are major shareholders in Delta, United, American, and Southwest. If these airlines truly competed aggressively, they'd undercut each other on prices to gain market share. But when the same shareholders own all the competitors, the incentive structure changes. Aggressive price competition that increases one airline's market share at another's expense doesn't benefit the common shareholders. They own both airlines. They'd prefer the entire industry remain profitable through restrained competition rather than destructive price wars that hurt margins across the board. Research has found that airline ticket prices are measurably higher on routes where common ownership by institutional investors is more concentrated. This isn't explicit collusion, which would be illegal. It's a structural result of ownership patterns creating aligned incentives. The airlines don't need to coordinate directly when their shareholders benefit from all of them maintaining profitable pricing. The market structure does the work without anyone breaking laws or meeting in smoke-filled rooms. The same logic applies across industries. Banking, where BlackRock and Vanguard are top shareholders in JP Morgan, Bank of America, Wells Fargo, and Citigroup. Do these banks compete as aggressively on fees and interest rates as they would if they had completely different ownership? Or does common ownership create a tacit understanding that the industry as a whole should remain profitable, that undercutting competitors hurts everyone's returns? We can't prove causation, but we can observe that banking fees remain high, that banks often move in lockstep on policy changes, and that genuine disruption from new competitors has been limited despite technological advances that should enable it. Media ownership shows the most direct implications. BlackRock and Vanguard own stakes in Disney, Comcast, Fox, Warner Bros. Discovery, Paramount, all of them. They own pieces of Netflix and Amazon Prime Video. They're invested in traditional media and streaming platforms. When you consume entertainment, news, or information, it's flowing through companies substantially owned by the same institutional investors. This creates both the appearance of diversity and the reality concentrated ownership. Hundreds of channels, endless content. But at the ownership level, the same names keep appearing. The grocery sector reveals how deep this goes into daily life. Kroger, Albertsons, Walmart, Target, Costco, BlackRock and Vanguard are major shareholders in all of them. They also own stakes in the food manufacturers whose products fill those stores' shelves. When you shop, you're making choices between stores and products that are substantially owned by the same institutional investors. The competition for your dollar is real. The stores fight for market share. But the major shareholders benefit regardless of which store you choose. This isn't necessarily illegal or even unethical by current standards. Index funds that track the market will automatically own shares in all major companies in every sector. That's the point of indexing. You can't own the S&P 500 without owning both Coke and Pepsi, both Kroger and Albertsons, both Delta and United. The common ownership is a natural result of index investing at scale, but natural doesn't mean benign. The effect on competition and consumer welfare is real, regardless of whether anyone intended it. Critics point to what this means for economic dynamism. In a truly competitive market, new entrants should be able to challenge incumbents. Innovation should disrupt established players. Creative destruction should constantly refresh the economy. But when the major shareholders own all the incumbents, when they benefit from the existing industry structure, when they have no particular interest in funding disruptors that might threaten their portfolio companies, the system becomes more static. The barriers to entry aren't just regulatory or financial, they're structural, baked into the ownership patterns that favor stability over disruption. Defenders argue that competition still functions, that management teams at individual companies still want to win against rivals, even if shareholders own pieces of all the companies. And there's truth to that. CEOs have egos. Employees care about their company's success. Customers actually do make choices that reward better products and services. The market still works at the operational level. But the incentive structures at the ownership level pull in different directions toward industry stability and profitability, rather than cutthroat competition that might hurt margins across the board. The question is whether this is the capitalism we think we have. We tell ourselves stories about the free market, about competition driving efficiency, about consumer choice disciplining corporations. But those stories assume that competitors actually compete, that ownership is diverse, that different entities benefit from different outcomes. When the same institutional investors own substantial stakes in all the major players across every sector, when the largest shareholders in Coke also own Pepsi, when the biggest investors in Delta also own United, the fundamental assumption of competitive markets breaks down. You walk down the supermarket aisle thinking you're exercising choice, and you are, in a narrow sense. The products are genuinely different. The companies do compete for your business. But zoom out one level. Look at who owns those companies, who profits from your spending, regardless of which brand you choose, and the choice becomes illusory. The diversity of products masks the concentration of ownership. The appearance of competition obscures the alignment of interests among major shareholders. This is the 21st century version of monopoly power. Not one company owning everything in one industry which antitrust law can address, but a few institutional investors owning significant stakes in every company across all industries, which our regulatory framework wasn't designed to handle. It's monopoly by another name, operating through financial ownership rather than direct control. Harder to see, but potentially more pervasive in its effects. And it's accelerating. As more money flows into index funds, as BlackRock and Vanguard grow larger, as their ownership percentages in individual companies increase, the concentration deepens. We're watching in real time as the illusion of choice becomes more complete, more brands, more products, more options than ever before. But fewer and fewer entities ultimately benefiting from all that activity. The market presents itself as diverse and competitive, while ownership consolidates to a degree that would have shocked antitrust regulators a generation ago. The truly unsettling part is that this happened without anyone planning it. No conspiracy was needed. Just the logical evolution of indexing, the growth of passive investing, the success of a few firms in capturing market share, and the mathematical reality that owning the whole market means owning all the competitors simultaneously. Each step made sense individually. The outcome is a system where two companies are significant shareholders in virtually every major corporation, where consumer choice is real at the product level but illusory at the ownership level, where the promise of competitive capitalism coexists with unprecedented concentration of financial interest. So yes, you can choose Coke or Pepsi, Ford or Chevy, CNN or Fox, iPhone or Android. The products are real, the differences matter. But don't fool yourself into thinking those choices mean what they used to mean. Don't believe that picking one brand over another is striking a blow for competition or rewarding the better company. At the level that actually matters, at the level where profits accumulate and power concentrates, your choice is largely irrelevant. BlackRock and Vanguard win either way. The illusion is that you're choosing between competitors. The reality is that you're choosing between products owned by the same interests. And that reality should concern anyone who believes competition and diversity of ownership are essential to a functioning market economy. So here we are. $19 trillion. Two companies. Every major corporation in the world. The story of BlackRock and Vanguard is the story of how modern capitalism evolved into something nobody quite planned, but everyone now lives with. It's the story of how power became invisible by becoming everywhere. How influence became unassailable by becoming impossible to pin down. How control became absolute by claiming to be passive. We started by asking a simple question: who really runs the world? And the answer we've uncovered is both clear and deeply unsatisfying. Not governments, though governments depend on them. Not individual billionaires, though they manage billionaires' money. Not shadowy cabals meeting in secret, though the reality is almost as disturbing. The world is increasingly run by institutional investors who are simultaneously omnipresent and invisible, powerful beyond measure but claiming to be neutral, shaping everything while asserting they control nothing. BlackRock and Vanguard represent the logical endpoint of financialization. When capital becomes more important than labor or production, when ownership becomes more valuable than creation, when managing money generates more wealth than making things, you get entities like these. They don't build products. They don't provide services that consumers directly purchase. They sit one layer above the real economy, collecting fees for moving money around, exercising voting rights on behalf of millions of dispersed shareholders, and accumulating influence that rivals nation-states while remaining private companies accountable primarily to themselves. The conspiracy theorists see puppet masters orchestrating a master plan. The reality is simultaneously less dramatic and more concerning. There's no master plan. There's just the relentless logic of capital-seeking return, the mathematics of compound growth, and the network effects of platforms that become essential infrastructure. BlackRock didn't set out to manage $11 trillion. They just kept doing what worked, kept winning clients, kept growing, and the system kept rewarding scale until they became too big to fail and too embedded to regulate effectively. Vanguard's story is similar but different. Jack Bogle created index funds to serve investors better, to lower costs and democratize investing, and in that sense, he succeeded brilliantly. Millions of people have built wealth through low-cost Vanguard funds who couldn't have afforded actively managed portfolios. But success at scale creates consequences nobody anticipated. When your idea becomes so successful that trillions of dollars flow through it, when your structure becomes so dominant that competitors have to copy it to survive, when your growth concentrates ownership to unprecedented degrees, the beneficial tool becomes something else entirely, something powerful, something systemic, something that might be too successful for society's good even as it serves individual investors well. This is the paradox at the heart of the BlackRock and Vanguard story. They're serving their clients. They're following fiduciary duty. They're operating within the law. They're providing products people want at prices people can afford. By most metrics, they're doing exactly what they're supposed to do. And yet the aggregate effect of their success is to concentrate economic power in ways that threaten the diversity and competition that healthy markets require. It's possible for something to be individually rational and collectively destructive. We might be watching that happen in real time. The numbers tell the story. 100% of S&P 500 companies have BlackRock or Vanguard among their top 3 institutional investors. 84% have one or the other as the single largest shareholder. $21 trillion under management on Aladdin. Major stakes in media companies, pharmaceutical firms, banks, energy companies, defense. Contractors, technology giants, and every consumer brand you can name. Relationships with central banks, sovereign wealth funds, and governments across the globe. This isn't power that announces itself. It's power that operates through structure, through ownership percentages and voting rights, through the boring mechanics of shareholder meetings and proxy voting that nobody pays attention to until it's too late to matter. And here's the thing that should keep people up at night. It's not stopping. It's accelerating. More money flows into passive funds every year. BlackRock and Vanguard grow larger with every market cycle. Their ownership percentages in individual companies increase as more investors choose index funds over active management or individual stock picking. Research suggests that if current trends continue, the big three could cast 40% of votes in S&P 500 companies within a decade or two. We're not at the end point. We're watching it unfold, and the trajectory points toward even greater concentration. What are the alternatives? How do you address power this diffuse and this embedded? Traditional antitrust law doesn't offer obvious solutions. You can't break up BlackRock and Vanguard the way you broke up Standard Oil or AT&T because they don't have monopolies in the traditional sense. They're not preventing competition in any single market. They're just large investors with stakes in many companies across many markets. Being big isn't illegal. Owning shares isn't illegal. Voting those shares isn't illegal. Everything they do operates within existing rules. The problem isn't that they're breaking laws. It's that the laws were written for a different era when this kind of concentrated ownership through institutional investors didn't exist and couldn't have been imagined. Some proposals have emerged. Limit the percentage of any single industry that one fund family can own. Require greater transparency in how voting decisions are made. Give individual investors more control over proxy voting for shares in their funds. Restrict common ownership of direct competitors. Designate systemically important asset managers as subject to enhanced oversight, the too big to fail framework applied to investment management. All of these have merit. None are easy to implement. All face fierce opposition from the industry and from investors who benefit from the current system's efficiency and low costs. There's also the question of whether regulation is even possible given the global nature of these firms. BlackRock and Vanguard operate across borders. They manage money for clients worldwide. They're invested in companies across continents. What regulatory body has jurisdiction? The SEC can regulate their US operations, but not their activities in Europe or Asia. European regulators can oversee their European business, but not their American or Asian operations. And international coordination on financial regulation is notoriously difficult, especially when nations compete to attract financial firms and the capital they manage. The regulatory arbitrage possibilities mean that aggressive oversight in one jurisdiction just pushes activity to more permissive jurisdictions. So we're left with a system that's simultaneously hyper-efficient and potentially fragile, that serves individual investors well while creating systemic risks, that operates legally while raising profound questions about the concentration of power in democratic societies. It's the defining contradiction of 21st century capitalism. The tools we created to democratize investing have, through their success, concentrated ownership in ways that undermine the diversity and competition that make capitalism work. The cure might be worse than the disease, but the disease is metastasizing. For the individual person trying to make sense of this, the implications are personal and immediate. The retirement account you're building through low-cost index funds is part of what gives BlackRock and Vanguard their power. Your savings help make them larger, more influential, more essential to the financial system. You benefit from their scale and efficiency. You also contribute to their dominance. There's no easy opt-out. If you want diversified exposure to the stock market at low cost, you almost have to go through one of the big three. They've become infrastructure, like electricity or water, something you use because alternatives barely exist. The rent you pay, the groceries you buy, the news you watch, the healthcare you receive, all of it flows through companies where BlackRock and Vanguard are major shareholders. You can't avoid them, even if you want to. They're woven into the fabric of the economy so completely that extraction would require unraveling the entire system. And maybe that's the point. Maybe when you become essential infrastructure, when everyone depends on you, when alternatives become unthinkable, you've achieved a form of power that's more durable than any monopoly because it's accepted as natural, as just how things work, as the market rather than as a distortion of the market. The conspiracy theories miss the real story because the truth is more subtle and more profound than any conspiracy. There's no shadowy elite controlling BlackRock and Vanguard. There's just the system operating as designed, rewarding scale and scope, creating feedback loops where success breeds more success, concentrating ownership without concentrating control, building power structures that look like markets but function like oligopolies. Its emergent complexity creating outcomes nobody intended but everyone now lives with. It's capitalism eating itself through hyper-efficiency, optimizing so effectively that diversity and competition get lost in the process. Ownership is invisible. That's the lesson of BlackRock and Vanguard. Power doesn't need to announce itself when it's structural. Influence doesn't require conspiracy when incentives align. Control doesn't demand explicit coordination when common ownership creates common interests. The system runs on autopilot, generating returns for investors while concentrating decision-making among institutional investors who are simultaneously everywhere and accountable to no one in particular. It's the perfect arrangement for those who benefit from it and invisible to those who don't understand it. So do BlackRock and Vanguard run the world? Yes and no. They don't set policies or pass laws. They don't directly make operational decisions at the companies they invest in. But they own pieces of everything. They vote on boards and governance. They influence strategy through stakeholder engagement. They allocate capital that determines which companies and industries thrive. They have relationships with governments and central banks that give them insight and influence beyond what any single company should have. They're not puppet masters. They're something potentially more consequential, invisible infrastructure that shapes outcomes without obviously controlling them. The question isn't whether this is a conspiracy. The question is whether this is the system we want. Whether concentrating this much economic power in unelected private institutions is compatible with democratic governance and broadly shared prosperity. Whether the efficiency gains from passive investing and institutional scale justify the loss of competition and diversity of ownership. Whether we're willing to regulate financial power the way we've historically regulated industrial power, or whether we'll let capital accumulation proceed unchecked because it operates through complex mechanisms that most people don't understand. These questions don't have easy answers, but they need to be asked. Because right now, two companies you've probably never thought about own significant pieces of nearly everything you interact with. They profit from your spending, your borrowing, your healthcare, your housing, your entertainment, your food. They're in every part of your life, invisible but omnipresent. And every day they grow a little larger, a little more embedded, a little more essential, a little more impossible to challenge or replace or even properly understand. That's the hidden empire, the silent power, the invisible hand that's not invisible because it's elegant or natural, but because it's too complex and too boring for most people to notice. BlackRock and Vanguard aren't the villains of this story. They're just the most successful players in a game whose rules nobody designed but everyone now plays. The real question is whether we're okay with that game continuing, whether we're comfortable with a world where ownership without ownership shapes everything. Where two names appear on the shareholder lists of nearly every major corporation, where $19 trillion in assets are managed by institutions that are powerful beyond measure, but accountable to abstractions rather than people. Welcome to the modern economy, where choice is illusory, where competition masks concentration. Where capitalism has evolved into something its founders wouldn't recognize and its critics underestimate. Where two companies you've never heard of might not control your life, but they're damn close. And they're only getting closer. If you found this eye-opening, if this changed how you see the world around you, hit that like button. Subscribe for more investigations into the systems that shape our lives. Share this with someone who needs to know. Because the only thing more dangerous than concentrated power is concentrated power that nobody's watching. Thanks for joining us on this journey through the invisible empire. Until next time, question everything. Follow the money. And remember, just because you can't see the strings doesn't mean they're not there.